The greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The only thing that's certain is uncertainty.
This whole rally has been fought. I don't think anybody's going to exit the markets on concerns that that is a certainty.
We're in the middle of a bull market. I think it has been around for quite a while, but it has legs to continue.
It's almost like chaos and uncertainty is just a given, and it's not holding people back, and the cyclical story can continue to remain.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Looking for record highs about 90 minutes away from the opening bell on the S&P 500 this morning. Futures are largely positive, likewise on the NASDAQ and on the Russell as well. For the week ahead, one thing sticks out. This week is the blackout period for the Federal Reserve. They go quiet, apart from one man. They go quiet until the meeting next week, next Wednesday. That one man is Chairman Powell. He speaks this week. In fact, he speaks tomorrow on the regulatory capital framework, so forget all of that. What we're interested in is if he pushes back in any way, shape or form against some of the headlines we've seen over the past week.
Does he come out and say, look, I am Fed chair, no one has the ability to fire me, including President Trump. The allegations around the renovations will be dealt with by this appeals board, but currently I am planning to serve out my term. Ultimately, whatever he says regarding this issue is going to be noteworthy, even though it is out of the blackout period.
It is the story down in Washington, D.C., in the nation's capital, that just won't die.
It won't die. And you have the Treasury Secretary who likely will also be at that conference tomorrow. So it'll be interesting potentially if these two individuals see each other. Remember what Scott Bessent told us. He thinks that if the Fed chair were to stay on, Jay Powell, and serve out his governor term till 2028, that would be confusing for the markets and create a shadow Fed chair situation. Basically what you have right now is they want some clarity, I think, on whether or not he's going to step aside or remain at the Fed.
I agree with Bramo. I don't think it's controversial to say it might be the story that won't die, but it's the story that everybody is just about sick of right now on Wall Street.
Yeah, I'm just thinking about that conference. Is it like the Jets and the Sharks, where like the Bessent crew and the Powell crew kind of walk by? Do they still have lunch every week? It's sort of
every other week.
Every other week. I mean, it sort of creates this interesting dynamic between the two of them when they're kind of pitted against each other. With Scott Bessent talking about the active search for his replacement.
And next week's going to be an interesting dynamic. They sit around that table at the Federal Reserve. Most people expect them to keep rates unchanged. Perhaps they will, but there could be some votes in there, some dissent, including from Governor Waller, who caught up with us just last Friday.
So how do they do it and keep the economic high ground? And this was something that Bob Michael really alluded to. How do they cut rates or indicate that they want to cut rates while showing that there is enough justification that makes it not just an audition to be the next Fed chair? And I think that is one concern. Does any Fed chair who takes the position next come with a lot of hair? And I'm not talking about a nice head of hair. I'm talking about this idea that they're going to be motivated to be more dovish, and that is how they got into the seat.
Governor Waller had a nice head of hair, didn't he?
He does. He's got lovely hair.
Fantastic. All
okay.
right. Futures, positive by 0.2%. What are you laughing at? Okay. Coming up this hour, Eric Friedman of US Bank Asset Management with stocks climbing, Anisha Sherman of Bernstein as consumer sentiment hits a 5-month high, and Chris Harvey of Wells Fargo with the most bullish S&P 500 target on the street. We begin this hour with stocks rising ahead of big tech earnings out this week. Eric Friedman of US Bank Asset Management writing the following: markets are front-running positive outcomes with earnings, tariff outcomes, and capital expenditures. We still see some upside ahead of us. Eric joins us now for more. Eric, welcome to the program, sir. Since we last spoke, we started to get some earnings. And since we last spoke, we got those earnings, and this market didn't do much in response. What do you make of the underwhelming response to some pretty decent earnings on Wall Street and beyond?
Yeah, to your point, Jonathan, it has been underwhelming. I think if you look at the thought process for investors like us, we're still waiting to see what the employment market will look like. And number two, what happens with CapEx. Those for us are the two big variables that we think need to happen to kind of push the markets higher from here. We have a target for this year at 63.25. That assumes, a little below consensus on earnings for this year, a little below next year as well. We start turning the page on 2026 in about 5 or 6 weeks. That's the way we kind of think through this earnings cycle. So in general, I think the thought process is simply this. This economy is supposed to slow down this quarter. We think it actually won't be as sharp a slowdown as consensus thinks. But we also think the bounce in Q4 and Q1 of next year will be positive. That being said, what we need to have is a bit more clarity on capital expenditures. That for us is the ultimate stir in the drink at the moment.
Eric, it's one of my favorite questions. Can you price the recovery to the slowdown we haven't had yet? Can you?
Yeah, I think it is something where the slowdown, Jonathan, is really in the eyes of what happens with consumers as opposed to businesses. Businesses are still in a really, really good spot in terms of flush balance sheets. Cash flows are generally very strong. But what we are seeing is still a hyper-promotional environment to get consumers off the couch and actually out spending money. If you look at the elasticity of demand right now, not to go into microeconomics, but there's a lot of consumers who are looking for deals. That's not new. It just continues. And so the slowdown, what we think will happen if either companies become less promotional, in other words, they actually decide to pass through more of their tariff costs, if you will, or if businesses just stop hiring. And so those would be the two things that thwart our glass half full perspective. But in general, we think the slowdown has certainly been falsely predicted for some time.
Eric, your view on markets is sort of pro-risk, but sort of also a little wary of the valuations and wanting to sort of adjust things in real time to try to capture that valuation mismatch at any given time. How would you describe this investing environment, this sort of very nuanced, kind of grinding higher, sort of vaguely positive, but also wary moment that's very different from some of the either all the way up or all the way down that we've seen over the past few years?
Yeah, at least I think you nailed it. I mean, it is a very nuanced environment. And so the way that we're approaching this as investors is that, look, we're paid to beat benchmarks. And so the way we think we're going to do that is by out yielding them. And that's true across both our equity portfolios, but also what we're doing within fixed income. So in this environment, we had the opportunity, like every investor, to flinch during the post tariff announcements, post the very back and forth episode with tariff negotiations. We didn't, but we really sold into strength. And so now the question for us is, at more of a neutral equity posturing, what do? We think that we want to own more carry in terms of fixed income. We also want to try to out yield an equity portfolio. So again, favoring financials. Certainly still being involved with big tech, but also owning things like midstream energy that spit off some reasonable cash flow for investors. So to your point about nuance, Lisa, this is not necessarily an all-clear environment where there's a great directional bias from consumers, especially those in the lower and middle income levels. Those for us will be the swing factors to propel us higher if, in fact, that glass half full perspective does come to fruition.
The one directional trade of 2025 has been the dollar, and it has been a one-way move downward or weaker versus all other major developed market currencies. I wonder how how essential that bet is to the ongoing returns of equities in the way that we've seen over the past couple of months.
Lisa, at the risk of pandering, I'm a huge fan of your Twitter feed. And I think if you look at what some of the great things you put out is, this notion of correlation versus causation. The equity market move, the crypto move, the real asset move has at least been correlated with a lower dollar. And the fact that you still have the dollar consolidating, even after the Japanese election results yesterday or ongoing back and forth trade negotiations with Europe, that suggests to us that if the dollar cannot pick its head above its, let's call it mid-June levels, that's a level that we have not seen been able to surpass in about 4 or 5 weeks, of course. That for us suggests that at least in the moments, the dollar is still going to be a tailwind, a lower dollar, a tailwind for more of the pro-risk assets as markets determine just how strong this bounce, if there is a bounce, will actually endure. So for us, we're paying very close attention to, can the DXY pick itself above the 200-day moving average. If it does that, along with a slowing labor market, that may actually cause us to be a bit more cautious. But for now, we think that the bias towards a lower dollar is likely intact.
And you like your international exposure when it comes to Europe and Japan. How are you thinking about potentially, though, Europe and Japan having higher tariff rates than when the president came out and rolled back the April 2nd Liberation Day? Because right now, it looks like, at least for EU, it's going to be higher than 10%. And Japan, they are still trying to get that 25% on autos down. And right now, the U.S. isn't buying it.
Yeah, Anne-Marie, it's a great point. I mean, the fundamental picture, if you look at the average company in Europe, for example, look, we're seeing an improvement in labor laws. We're seeing a little more mobility of labor. That's a good thing. But to your point, there's only so much that a company can traverse if tariff costs go up above their ability to actually either endure them or pass them through to customers. So these next couple of weeks, we think that August 1st deadline, we'll see if it actually holds. But, you know, the fact, if you look at some of the negotiations, again, you've done a nice job of reporting on this, we're really into the microeconomics of European-U.S. trade right now. That, for us, is a bit of a concern just in terms of the, you know, again, at some point, perhaps there's just a throw the hands up in the air and say, you know, we're done with this micro look. We're just going to increase the effective tariff rate above some really high hurdle. That, for us, would be a negative. So we think that for now, the fact there is still more back and forth on micro is a good thing. The average company fundamentals we think are actually solid, but that being said, a higher effective tariff, you know, something, you know, 15, 20% on a gross basis across the board, that for us would be more concerning about our pro-international positioning right now.
Eric, stop being so nice. I've tried. It doesn't work.
What do you mean it doesn't work?
I do it every morning. It doesn't work.
What, you feel like you're abused
Bully me every
morning?
Commercial break.
Oh, yeah.
Eric, thank you, sir.
So we all
Eric Friedman of
so
US Bank
mean.
Asset Management with the latest. I want to share this with you, okay? Got some time.
Please.
This came from Michael Arue out on X. Here's the full quote. I'm not actually sure where the full quote is from, but here it is. People in the EU are super wise. You have a meal with some sort of French person who works in Brussels. It's very impressive. They're cultured. They have wonderful taste. They understand all these different countries. They know something about Chinese porcelain. And if you lived in a world ruled by them, the growth rate would be negative 1%.
That's amazing. Well, it's kind of been what's happened recently is that, you know, the whole idea, right, the U.S. innovates, the China replicates, and the European Union regulates, and that's what we've heard. Thank you for catching my lack of mental capacity this morning. But there has been a push, though, in the EU to actually cause bank mergers and actually allows for more of this. But you're right.
Change the culture.
The Draghi report.
How do you do that, though?
That's going to take a long time.
And what's wrong with knowing about Chinese porcelain?
Absolutely nothing, clearly, as evidenced by that quote.
Yes,
you know,
right,
people are impressed by that.
Correct, but how do you translate that into?
You need to get beyond that and actually do things that generate growth. Right? Okay, anyway, thought I'd share that with you this morning. Equity futures on the S&P up by 0.2%. Quiet, as you might have noticed. Let's get you an update on news worldwide with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump and Xi Jinping are reportedly expected to meet at or before the APEC summit in October. The South China Morning Post cites sources saying Trump could make a stop in China on his way to the summit in South Korea, or they could meet on the sidelines. Sources telling us here at Bloomberg that Trump has been dialing down his aggressive tone with China in hopes of securing a meeting and a trade deal. Meanwhile, EU officials will meet in the coming days to discuss how to respond to a possible no-deal trade scenario with President Trump. The move comes as the U.S. is set to be seeking tariffs on EU goods higher than 10% with limited exceptions. Like others, the EU faces an August 1st deadline to strike a deal or see higher tariffs. And Blackstone is out. It has pulled out of a bid for a stake in TikTok's U.S. operations. Sources telling us here at Bloomberg the firm has offered its potential share to other investors in a consortium that includes Oracle, Andreessen Horowitz, and General Atlantic. TikTok is facing a September deadline to find an American owner or be banned in the U.S. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes. Up next, the Morning Calls Plus. Anisha Sherman of Bernstein as consumer sentiment hits a 5-month high. Live from New York, this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At a certain point, you realize investors are thinking a little bit differently than you are, and you adjust and move on. And that's what we did with our target raise last week. People felt like they paid the price for whatever economic wobbles we were going to have, whatever inflation, kind of challenges we were going to have back in April, and it was time to move on to 2026. As you start hearing it from more and more people, of different backgrounds, you realize you've got to bake that into your thinking. And so that's essentially what we did.
Tons of respect for Laurie Calvasina of RBC. Joined us on the program a little bit earlier. All of a sudden, this market has shifted its emphasis and focus beyond these deadlines around trade, what could happen, what might not happen with the Federal Reserve. It's focused on earnings in 26 and beyond.
If you can't measure it, why even think about it? If we're going to play headline roulette every single day and get whipside and be wrong, why not just ignore it all and move on to what you do know, which is the earnings and some of the investment that we keep seeing?
Laurie raised her price target. We'll speak to a man who hasn't moved his price target at all year. Chris Harvey of Wells Fargo later on the show, the most bullish on the street, north of 7K.
And he's been right. I mean, this is the amazing thing. The question is, are we getting to pretty lofty levels where we have to see some of the earnings come through, and we are embarking on a pretty massive earnings season where maybe we get a little bit more color other than just headline roulette?
So far, so good. On the earnings front, equity futures this morning positive by 0.2% on the S&P, up by 0.2 also on the Nasdaq. That's the price action. Let's get you some morning calls. First up, Benchmark initiating coverage of GM with a buy rating, saying its core business remains resilient despite tariff uncertainty. That stock is up by 0.4%. Your second call from Morgan Stanley raising its recommendation on Pinterest to overweight, citing improving macroeconomic trends. And finally, Barclays downgrading target to underweight, citing weak trends among the company's most frequent shoppers. That stock is down by about 1.6%. Let's stick with the retail and the U.S. consumer. Consumer sentiment hitting a 5-month high as the outlook for the economy and inflation continues to improve. Joining us around the table, Bloomberg's Emily Cohn. Emily, good morning.
Good morning.
Things have started to turn around for consumer sentiment and the outlook for inflation as well. We saw that in the data on Friday. What's driving that?
So I think this is a little bit of a consumers are not going to hold out spending forever type thing. So consumer sentiment peaked, was its worst after Trump made his worst tariff threats. Now what we're seeing is a lot of those threats that he made early on haven't come to fruition yet. We're not seeing tariffs raise prices as much as we worried that they might. Some of the more tariff-sensitive categories, prices are up, toys, furniture. But for the most part, consumers aren't going to hold back spending forever. They're feeling a little bit more comfortable. They're spending again. I think the key here is we still haven't seen the worst that might come. And consumers, we just don't know, it might get worse.
This is what we're trying to figure out as well, just how much of these companies have been working through pre-tariff inventory, how much of this is about corporate resilience, or whether it's just the result of extensions and exemptions, and we haven't really seen the tariff hit just yet.
And depending on how you believe this to be shaking out, you'll get a sense of whether you see it to be inflationary. I think the thing that you pointed out there, though, is really key, which is the idea of contracts in place that set certain shipping rates. So you haven't seen those trickle into the actual pricing for companies in a large scale. All of these things offsetting just marginally in each particular corporate story.
Is this a risk for Q3, Q4? How are you thinking about the balance of risk for the remainder of the year?
I think you're 100% right. I think a lot of these companies bought a lot of their inventory months ahead. So a lot of the inventory that we're selling right now, maybe they had before the tariffs were in place. I think what we're going to watch is back to school shopping, holiday sales, Those are the types of inventory that these companies have to get a hold of, or had to have gotten a hold of April, May, June, when the tariff threats were at their height. And we'll have to see if they begin to start passing those prices along to consumers more than they have to date.
Emily Cohn, it's good to see you.
Thank you so much.
Thanks for dropping by. Appreciate it. Let's extend the conversation with Anisha Sherman of Bernstein, writing the following. Secondary demand impacts continue to be a risk as price increases roll out, particularly for lower income exposed companies. Anisha joins us now for more. Anisha, welcome to the program. A lot of companies in your coverage. Talk to us about the companies right now that seem to be in a tough spot.
Yeah, so we have had these August tariff announcements come out. They are better than feared. So we've seen some of the stocks rally, but they are worse than the pause rates that we're at currently. And so we should see tariff impacts worsen across the back half. Now, the challenge is the timing. So we're about to enter the Q2 earnings cycle. These August tariffs don't impact Q2, both on the supply side, because that August shipment inventory is Q3 inventory, and also on the demand side, as your previous guest just said, the price increases that started to roll out in June and are ramping in July and will continue to ramp in August are not going to materially impact Q2 earnings. So it's really the back half earnings that are at risk from a worsening tariff environment compared to the pause rates. And we'll see, because some of these unmitigated impacts are kind of 100 to 250 basis points of gross margin headwind on most of my coverage, but that's the unmitigated impact. And these companies have now had months and months to work on mitigation efforts. So the net impacts of those could be smaller. So, the net message is it will be worse, but it could be just slightly worse. It might not be a doomsday scenario. And we'll have to see what the Q3 guidance looks like, and that's going to be the main data point I'm looking for in the earnings cycle.
What have we learned so far? And I realize it's very early in the earnings cycle, but we've heard from the likes of Delta. We heard from Domino's doing great with their stuffed crust pizza this morning. I'm just wondering, what have we learned about consumer tolerance for higher prices, consumer willingness to keep spending, and their ability to do so?
Yeah, it's interesting because we've seen this consumer sentiment data get worse and worse, right, up until this month. But we haven't really seen an impact on spending. And really what's going on is it's an anticipatory sentiment decline, where consumers are reading the news and the headlines in the media. They're worried about tariffs hitting the price points, but we haven't seen that happen yet. And so we're seeing a deterioration in sentiment. And even now, July has gotten a bit better, but it's still far worse than it was at the start of the year. But we haven't seen that translate into a spending pullback yet, particularly for higher income consumers who tend to be lower beta anyway, and they are less impacted by a change in price points. I think that where we might see the other shoe drop is depending on the magnitude of the price increases, we could then see a pullback in actual spending. So that has not happened yet. And I don't think it happens in Q2 either, because like I said, those price increases have barely started towards the end of Q2. So late June and July is when those price increases are going to start to ramp. So we could see it in Q2 exit rates for some of the retailers that end their quarter at the end of July. But really where we're going to see it is in early Q3. So the commentary around quarter to date, Q3 trading, Q3 guidance, and data points around most recent consumer trends, that's where we're going to start to see the demand impacts. We haven't seen it yet.
Governor Waller was on Friday, and he was talking about the impact of tariffs, and he said it's a third across the board. Suppliers hit a third, firms hit a third, and the consumer absorbs a third. Is that how you view how it's distributed across the supply chain?
Not yet. So far, what we've seen is suppliers have borne the brunt of it, and we've talked to many suppliers that sell to some of the big general retailers here in the U.S., and they've said those retailers have just pushed back on suppliers and said, you guys need to bear the brunt of this. And remember, the retailers are in a much better bargaining position here. They have diversified supply chains across multiple markets, across thousands of suppliers, so they can't afford to do that. As those tariff rates now increase, so comparing the August 1st rates versus the pause rates, that next leg up is going to be borne by retailers and consumers. So far, it's been disproportionately pushed to suppliers as companies have tried to do cost side mitigation and not pricing side mitigation. That balance is going to shift. So I don't know if it will be fully a third absorbed by retailers. I think the retailers are going to try to pass them up and down the supply chain and onto consumers. But I do think that rough proportionate split is right. So far, it's been very supplier absorbed. That's going to shift.
Anisha, always a clinic with you. Appreciate your time this morning. Thank you. Anisha Sherman there of Bernstein, reflecting what many expect later this summer, which is prices firming up. Got a hint of it in CPI just last week. A lot of people think it will continue. The debate is whether it continues to beyond that, whether it just fades beyond that. And I'm pleased you brought up Governor Waller, because he makes two assumptions. One, a large share of tariff increases won't be passed through to the consumer. But two, increases would fade over the next year or so. And that's the ultimate call for the Federal Reserve. Do you look through it and carry on your business?
And a lot of it hinges on wage growth, and that's what we heard Bob Michael talk about. And if you don't see that labor market pressure and the tightness in the labor market that leads to that kind of wage growth, you aren't going to see consumers really doubling down and accepting those higher prices. I just look at Domino's, and pizzas are, $10. So if you buy more of them, what's the only thing that could make a perfect pizza even more perfect?
There's better pizza in New York. I'm going to take you to Arthur Avenue, but the Michigan survey on Friday, I know Governor Waller just calls it that thing, that Michigan thing, but actually the sentiment was up even on that thing. And he makes this case that you can just look through this tariff impacts. Even if it hits a consumer, it's just going to be a third.
Is that your favorite pizza, Arthur Avenue?
Well, it's the best Italian food in New York.
Okay.
It's good, but, across stuffed full of
Just
cheesy
wondering. All right.
goodness. No, it's
Goodness
good.
me. All
That's
right.
it? It's great.
Excellent.
Quite basic. Ruby Rosa, Mulberry Street.
Ooh.
Yeah.
They have gluten-free pizza.
Yeah,
It's fantastic
So it is
pizza.
good.
Okay, good to know.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
60 minutes away from the opening bell. Equity futures doing okay, positive by 0.2%. Let's get you some morning movers this morning. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Some more earnings this morning. Cleveland-Cliffs, that is the steel maker. Shares are higher in the pre-market, reported a loss of 50 cents per share. That is better than what's expected, but maybe it's the look forward. The CEO talking about how tariffs on the steel industry are going to be helping them and other domestic manufacturers. So they're really seeing that start to play out now. So again, those shares up 6 1/3%. We also heard from Verizon in the past hour. Those shares up 4%. An upgrade for their full year outlook, also for free cash flow, beating because they say of tax reforms, strong businesses, and they also were able to raise prices when it comes to their wireless business. Finally, rounding things out with Tesla, just pointing out that it is gaining ahead of its earnings report on Wednesday, 1.6%. Possibly helping things out this morning, too. Elon Musk was out on X yesterday saying that he's back to 7 days a week in the office and sleeping in the office when his little kids aren't around. So it's perhaps that recommitment to his companies and away from politics that investors like, John.
The work ethic of that man. Unbelievable. Tesla positive by 1.6%. Danny, thank you. Let's turn to the week ahead. Busy week of earnings. That kicks off on Wednesday with Alphabet and Tesla. Lots of economic data as well. Look out for another round of jobless claims on Thursday. And interestingly, we're going to get a speech from Fed Chair Jay Powell. We'll get that speech tomorrow. Bloomberg's Might Be Key joined us now for more. Michael, as you know, we're in the quiet period from the Fed. What can we expect from Chairman Powell?
Not a whole lot. This is a conference on banking regulation, the Basel III agreement and the SLR and things like that. This is not going to make any news. He's not going to be able to comment on anything to do with the economy or monetary policy. Vice Chair Mickey Bowman speaking at the same conference. As you mentioned, it is a kind of quiet week otherwise, and we hate to get people's hopes up. But the breaking news today is Jay Powell is, at the moment, still the Fed chair. And we haven't heard from Donald Trump about that in 24 hours. So we'll see how the rest of the week goes. As you mentioned, we do have those speeches tomorrow. We've got the leading indicators index, which we have all forgotten about because in 37 of the last 41 months, it has been negative. So it's been signaling recession for 37 months out of the last 41, and we haven't gotten it, so nobody really cares that much about that. But that used to be a big number. Existing home sales and new home sales also on the calendar this week, along with, as you mentioned, the jobless claims numbers. And we get S&P PMIs on Thursday. We'll see what they tell us about next week's ISM number. The one thing that's interesting to watch here is even though the president may or may not have backed off of Jay Powell, the markets are still a little bit concerned. If you look at the 10-year note yield, it is above where it was before the president last suggested that he is going to fire Jay Powell. So there's still some concern in the bond market about that. Everybody will be keeping an eye on the president's social media feeds and our headlines to see if anything changes in that regard this week.
Mike McKee, next week. Let's talk about next week. You'll be in the room with Fed Chair Jay Powell next Wednesday. How much of that news conference is just going to be about that man's future?
I don't think a lot, and only because Powell has been very clear that he's not going to talk about it. He's going to probably just tell us he's not quitting, and if the president tries to do something, they'll sue. What will be interesting, though, is to see the breakdown of the vote and see if Chris Waller, a candidate for Fed chair, dissents, and if Mickey Bowman, who has also said July might be a good month to have a rate cut, also dissents and suggests some sort of rebellion against the Fed chair.
Michael McKee, thank you, sir. Looking forward to your coverage over the next week. Just a little tip for anyone going to that news conference with Chairman Powell. He likes the one-word answer. Have a spare question, okay?
Smart.
Just so you can come back at them again. Maybe have another one after that so you can come back again.
Yeah, or you could do open-ended questions. Are you concerned about Fed independence? Do you think that this is going, okay, all right, hold on a second. And then, do you think that right now that affects the way you communicate and the fact that the market is taking a very different communication? No? Right? Nope. I mean, but then you just sort of, I imagine people are trying.
I'm totally with you. We explored this with Governor Waller last week, and I think it's a really important question. Whether we're seeing this pressure lead to a de-anchoring of inflation expectations because people do think central bank independence is being eroded. Now, we don't see any sign of that at the moment, at least not in a major way. But I wonder if that would contribute to how they do communicate in the coming months, whether it makes them ultimately just that little bit more hawkish.
Exactly, because otherwise you could ask, well, why not cut 25 basis points if you don't see this really affecting inflation expectations at this stage? You can ask all these questions and then say, okay, but what about the political potential ramifications and how much is that stymieing that decision?
Mike talked about a rebellion potentially from Governor Waller and Mickey Bowman. Is it a rebellion or what Governor Waller said around this table on Friday, which was you should have diversity of thought. This is a deliberative body. We don't need to all move in this think tank setting where we all move at the same pace and in the same direction. There should be debate. So if he comes out with a dissent, it's going to be a real debate. The question is, can he bring the rest of the board over with him?
Dissent is healthy. It's unhealthy if you think every single dissent is just driven by someone who's motivated to become the next Fed chair. Well, that's problematic.
That's exactly it. So there could be legitimate arguments economically, but do they get overshadowed by some of the political noise? And that's one of the ramifications of really having this ongoing discussion.
Also, Trump isn't calling him yet. He still has this veneer of being super independent in the sense that Trump has not reached out to him yet. He said that at his speech in New York, and he said that here on Friday.
Let's continue the conversation. Claudia Sam of New Century Advisors joins us now for more. Claudia, welcome back to the show. It's good to see you, as always. I want to pick up on that speech from Governor Waller, what he said before our conversation with him. Looking across the soft and hard data, I get a picture of a labour market on the edge. Do you get a picture of a labour market on the edge?
That's not how I would characterize the labor market, but I think Governor Waller lays out a very reasonable argument for reading the data, right? The labor market has some cracks, has some weaknesses to it. I mean, I think they were maybe more apparent last year as, the unemployment rate had been rising. But he paints a picture and he ties it to data. Again, I think it's really unfortunate that it becomes wrapped in this conversation of, is this a politicized view of his? I don't see it that way. But just to have that kind of injected in the conversation does tend to undermine what he's saying.
Claudia, do you think from your perspective and your years of experience studying the labor market and how that affects Fed policy, do you think that right now weakening in the labor market really is a greater concern than a prolonged, protracted inflationary push from the tariffs and from strength that we have seen ongoing in corporate America?
So I would agree that there are several threats on the growth side to policies that have been put in place. I mean, tariffs have an aspect of weakening growth through the higher prices. We've seen immigration policy. I mean, there's a whole set of reasons why you look out at this year, and we've seen growth slow this year, and that will eventually show up in the labor market. So you definitely can see those risks. And if one, as Christopher Waller lays out, looks at the potential inflation risks and says, these are temporary, we can look through these, then I think it would be right back to where we were, in 2019, where the Federal Reserve, faced with tariffs, they cut preemptively. It's just we're not in an environment where inflation is subdued. It's actually been above target for more than 4 years. There are real risks there. We still don't know what the tariff policy actually is. It could be going higher. It could not. So there's just a lot of uncertainty, I think, with the way that the kind of majority of the Fed is lining up their arguments makes a lot of sense. But there is a real perspective, and I would agree that the diversity of thought on the Fed and making those arguments carefully with data, that's a good thing. It's just, it is extremely unfortunate, the environment, by having the White House and the president very directly say what they want to see in terms of rates. It's kind of created this, it's made it really difficult for the Fed to have this kind of disciplined data conversation.
And it's even more difficult by the fact that the data is really confusing and it can paint a different story depending on how you read it. I mean, we keep kind of wondering what the labor market is showing us, whether it does show some sort of more dramatic weakening or whether the housing market is kind of ringing a 5-alarm fire alarm saying, hey, we're clearly is a problem. I mean, at what point do you think that keeping rates at this level would really create a weakness that currently hasn't manifested itself in the economy?
We're likely pointed in that direction. I mean, the economy has proven quite resilient. I mean, this is not just talking about this year, but in recent years, the higher interest rates, and there are probably a lot of different reasons for that. But eventually, we do see in interest rate sensitive sectors like housing, we do see these rates weighing down. The reason that the federal funds rate is elevated is because it is trying to push down on inflation. Once the inflation issue is taken care of, well, then there's no reason to have the rates as high as they are. And you should see them coming down. And the Fed tells us that's the direction they're pointed in. They're just not ready to take that move. But there are costs
there are costs in the economy to the Fed having interest rates as high as they are. And we will see those costs build as interest rates stay higher. So, but we're not looking at some dramatic falling off a cliff. We're looking at more of a slow grind, and it does impact certain parts of the economy, certain consumers, people trying to buy homes. Like that is where the effect is. But the goal is to get, inflation down. Unfortunately, we've gotten data that it's, moving in the wrong direction. That may be temporary, but like there's a reason that rates are where they are. It's not. But there are costs.
Governor Waller, though, is looking at these cracks in the labor market. Even individuals like Mary Daly is talking about it's reasonable to expect 2 cuts this year. Claudia, when do you expect the Fed to first move?
So it will absolutely depend on the data as they go forward, but there is certainly a case. And I think, keep an eye on the inflation data that's not connected to tariffs. I mean, I think that's actually been part of the encouraging cases that we've seen some weakness in some discretionary spending areas, and housing has certainly shown some cooling off. So I think they're building, the data are building the case, as long as, the tariff risks don't really move much higher, things really go dramatically sideways. I think they're on track for September or October, as the data come in. And Governor Waller could absolutely be correct that we see some employment numbers that are not as positive as recent ones, and that could move them much more quickly to the cut. But I think the data thus far have supported their let's wait and see. And I think that's where they're going to come down as a group next week. But of course, you can look at the data differently, and they are pointed in the direction of cuts. I mean, some aren't even looking for them this year, but I mean, that's, they have a lot of coherence in what they're thinking. It's just timing is hard. It's just really hard to figure out because timing is hard in the economy.
Claudia, appreciate your time. As always, Claudia Sam there of New Century Advisors, just to echo everything Claudia said, particularly at the end there, the bias is still to reduce interest rates at the Federal Reserve. That is still the direction of travel.
And that would have been even without the pressure from the White House. And I think that that's really the important point here. How do you message it now, and how much does it get complicated by the political overlay that currently exists?
I agree with her also that it's super unfortunate that this is where we are. The credible arguments for lower interest rates are just being basically accused of ambitious goals to become the next Fed chair.
Yeah, especially because a lot of economists on Wall Street have been making the same arguments for quite a while, and that, I think, really goes to the heart of the legitimacy behind a lot of these arguments.
Let's see if we get some healthy dissent at next week's meeting. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. Microsoft server software was exploited by unidentified hackers. The U.S. Cybersecurity and Infrastructure Security Agency said they accessed file systems and internal configurations, while Microsoft said it released a new security patch to mitigate the attacks. The Washington Post is reporting U.S. federal and state agencies are among those affected. Meanwhile, a Delta Airlines jet was forced to abort landing to avoid a mid-air collision with a B-52 bomber. The incident happened last week in North Dakota near an Air Force base. Citing the pilot, ABC News reported the plane had to make an aggressive go-around maneuver as the other aircraft became visible. ABC News also says that afterward, the pilot apologized to passengers. And President Trump is threatening to block the Washington Commanders' bid to build a new stadium in D.C. The president says he won't make a deal unless the team changes its name back to the Redskins, a term considered offensive to Native Americans. But Trump claims there's a big clamoring from them to restore the old name. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day and a week ahead. Plus, we'll catch up with Chris Harvey of Wells Fargo with the most bullish S&P 500 target on the street. That conversation up next.
Bloomberg launches our inaugural 25 African Startups to Watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We're integrated in every refrigerator, a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle, that they're not there. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market.
Bob Michael of JP Morgan Asset Management on the program a little bit earlier this morning. In the market right now, equity futures positive, bonds are too, yields are lower, futures are up by 0.2%, and your bond market looks like this: 2s, 10s, and 30s. Your 30-year yield is south of 5%. We're down 6 on the session to 492. Your 10-year is 436. Bob Michael's saying, I don't see the 10-year at 5%. He sees reasons that they belong there, but he doesn't see them getting there.
Which shows the incredible bid for bonds and how globally there's this incredible demand. I would argue that what we're seeing today is a bit of the Japan effect, and how we're getting whipsawed by the fact that it's not as bad as it could have been, with sort of fiscal irresponsibility, potentially maybe on the Japanese side. But, you know, he's making an argument for bonds. Let's see what happens if the Fed cuts by 50 basis points.
You think the Fed cuts 50 basis points?
No, I don't think so, but I'm saying that what happens.
Worth exploring that.
Like, just basically counterfactual on this Monday morning.
If they went 50 next week, for instance, what would happen to the long end?
It would probably, you'd see yields up, you'd see price down in a significant way, and it would raise questions about independence.
Which is what we saw at the back end of last year. Futures this morning then, just about positive by 0.2%. The bond market doing okay. Thank you, Japan. According to Lisa, Japan in the driver's seat in many ways over the past few weeks in fixed income worldwide. That's the price action. Your week ahead is shaping up as follows. Coming up a little bit later in the week, we'll hear from Fed Chair Jay Powell speaking at the FOMC's regulatory conference. On to Wednesday, results from Tesla and Alphabet. On Thursday, a rate decision from the ECB and earnings from Intel and American Airlines, plus another round of jobless claims. And then on Friday, going into the weekend, durable goods. Let's stay on the market. Stocks trading near all-time highs. Chris Harvey of Wells Fargo, the most bullish man on Wall Street. S&P 500 price target of 7,007, and he joins us now for more. Good morning, Chris.
Good morning.
You uncomfortable with that? I want to give you some credit before we start. Credit to you for not changing this call in the tariff storm of early April. So let's start there. Why did you stick with it?
So 9 months in the financial market, that's an eternity. The other thing, we had seen Trump 1.0. We know his style. It's to go out to the nth degree and then to come back in. Furthermore, the underlying fundamentals were still fine, and our EPS and our price target wasn't predicated on a strong economy. What we're seeing is the winners continue to win. The Uber cap companies have the higher margins, are gaining more market share. There is a real secular trade in AI that will continue. I was here during the 90s. This is not a fair comparison. It is much stronger, and the fundamentals are much better today than they were back then.
7K is not tariff dependent. It is not August 1 dependent.
No. So people ask, well, what's the fear? The fear is, there's a couple fears. One is, do tariffs start to flare back up? And that's possible, right? We just can't predict that. The other fear, which is a much more real fear, is what's happening with the Fed. Do we worry about the Fed and confidence in the Fed? Because the back and forth between the Fed and the White House, that's not healthy, right? And that can cause problems in the bond market, and that can cause problems with confidence. But overall, we're starting to see M&A activity kick up. We think that M&A will continue to be very, very healthy up and down the capitalization. We do think the Fed's going to cut. Fundamentals are fine, the consumer's okay, and we're not seeing the kind of price increases that people are talking about. We're seeing people say surgical when they're talking about price increases and selectively.
So there's a lot to unpack there, and we'll get to the Fed independence in just a second, and what point yields have to rise to before that really triggers some sort of response in equity markets. What about valuations? The idea that you're talking about an 11% gain from where we are right now on the S&P 500 after already reaching record highs amid a wall of worry and, frankly, growth that is expected to slow.
Right. So we talk about this all the time because people say, oh, look at 20 years ago, look at 25 years ago. The S&P is not the same as it was 25 years ago. The constituent in the S&P 500 is much more growthy. It's much more techy. The multiples are much higher. The productivity is much better. The people running the companies are much more attuned, and the acumen is much higher. And so the valuation, yes, it's high, but it's justified in our minds. And again, we don't need to see a whole lot of multiple expansion to get to that level. We're not very far from that level at this point in time.
So valuation concerns don't really you don't spend a lot of time on those. I do want to go to the Fed independence side, though. There is a question of what point yields have to rise to before it triggers true concern in stock markets, because we've asked that question many times. People give us a level, and then we pass that level, and stock markets shrug it off and say, healthy, healthy, good.
Yeah, it's hard for me to really answer that question. I think what's happening right now is you had Trump come out and say, I'm not going to fire Powell, right? And I think he needs to go out and say that, right? There's a lot of talk and rumors and situations in the marketplace. At the end of the day, we need the Fed. We need the Fed to be independent. We need the Fed to be apolitical, because it is a very important part of our marketplace. And as long as we can do that, that's great. I don't know if rates really have a play in this. I think it's just cooler heads need to prevail.
You read Trump correctly when it comes to tariffs. He put out a truth over the weekend about what Bessent potentially laid out to him when it comes to the market impact of firing Bessent. People don't explain to me, I explain to them, says the President of the United States. Did you take that as him basically acknowledging he understands the negative impacts that could have on financial markets?
I think his team understands. I think he understands. I think if you go back, and one of when we were on the show a while ago, we were talking about, will the feedback loop close, right? Will the administration see what's happening in the capital markets and react to that? And they did. So I do think they understand, but I also think that he feels like he's playing with a very strong hand, and to a certain degree he is. And he's looking at tariffs as a revenue generator, right? We have what we have with the deficit, and saying, hey, this could be a good way to reduce the deficit. We haven't seen the real impact to the economy. What's the big deal?
In that same truth, he said if it weren't for him, the market wouldn't be at record highs right now. But if it weren't for him, would potentially already be at your 7007 mark.
Yeah, there's a lot of speculation on speculation there. I think we could have done this. Talk in my book, one of the things I said, and one of the things I believe is you could have put a 10% tariff on and then just walked away, right? We talked about how there was a seller's tariff and how people, whether it's through Airbnb or Amazon, they understand it. You had Congress put that 10% tariff on, walk away, and we can do something more productive. But we chose this path, and it's okay. It's a little bit bumpy, but we're getting there.
Might get bumpier. Peter Schiff, Academy. Without the markets pressuring the administration, why would they pull back going into next month?
Well, this to me is the key question. How much is this administration playing chicken on tariffs with the market? If the market's looking past something that hasn't happened yet, does that push them to potentially go even harder because they could extract more, they could offset the deficit concerns from the one big beautiful bill, and there we go.
And you see these countries lining up to really want to do deals and getting a little bit nervous when you have Howard Lutnick, the Commerce Secretary, coming on Sunday shows saying August 1st is hard to stop deal. Also, he's already telling us what to expect next year. He said, of course, we're going to renegotiate USMCA so we could prepare for more headwinds in terms of Canada, Mexico, and the United States.
It's going to keep coming. It's going to keep coming. Chris, just to wrap it up, the US versus the rest of the world. What have you made of that debate over the year so far?
So we thought that was possible. We thought that was probable early in the year. It happened. Now we're just walking away. We just don't. We're done. We're good. You had that repricing. Now let's go back to fundamentals, and the fundamentals are telling you back to the U.S., back to growth.
Chris Harvey of Wells Fargo. Appreciate it, sir. Thanks for being here. It lasted how long? 5 months? 6 months?
Always a tourist in Europe. That seems to be what it is, whether it's markets or whether it's otherwise.
That's beautiful.
Thank you.
You should frame that. That's a fantastic quote.
Well, I mean, that's sort of how it feels to me. And people sort of get excited about the prospects of growth, and then they head over there and experience the regulation and some of the other hang-ups with certain labor market structures, and then they come back here. And that's been what it's been going on for a while.
Always a tourist in Europe. Bramo. July 21, 25. Coming up tomorrow, Matt Miskin of Manulife, John Hancock, Russ Brownback of BlackRock, Dan Nars of Nars Investment Management, Andrew Hollenhorst of Citi. From all of us, thank you for choosing Bloomberg TV. From New York City, this was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Futures edging higher this morning ahead of a hefty earnings week. 30 minutes until the official start of trading.
I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, big tech on deck. Investors bracing for a busy earnings week that includes results from Tesla and from Alphabet. Meanwhile, Invesco wants to break open its QQQ piggy bank. Wall Street calling it a game-changing event, and the IPO market heating up as Figma readies what could be one of the biggest listings of the year. All of that and more coming up in the next hour. But Shonali, let's get a check on what's moving under the hood right now.
Green on the screen for the big tech firms ahead of those earnings. Huge earnings week underway. The first set of Magnificent Seven stocks reporting. Wednesday, you have Tesla and Alphabet, both stocks still down on the year, Katie, but up pre-market. Intel, too, up about 0.9% as investors await more news.
So that to come, Verizon kicking us off this morning on this earnings week, posting a surprise net loss of subscribers, but it raised its profit outlook, citing President Trump's tax bill and wireless price increases. Let's break down these results with Bloomberg Telecom reporter Kelsey Griffiths. So talk us through the fact that this was a beat and raise, but at the same time, they actually lost subscribers. Was this all due to price increases?
Yeah, so a word that you hear used to describe Verizon often is disciplined. I was just listening to the call with investors a few minutes ago, and the word discipline was coming up a lot. So I think what we're seeing here is this sort of mixed approach that Verizon is taking. They have been investing in a lot of aggressive promotions in the last several months, in the last quarter, in order to sort of catch up with some of their competitors that never stopped running promotions after the holiday season. But we're also seeing that they're not going to do that at the expense of other financials. So we did end up seeing their revenue doing really well, and we saw them raise their full year guidance on several metrics.
Well, part of that was due to what they said was favorable tax reform. When they're raising their guidance, how are investors absorbing that impact? Are they seeing this as a one-time gain, or is this something that could be more sustainable and have a ripple effect?
I think we're still hoping to hear a bit more from Verizon on what their outlook is there and how they hope to apply these favorable tax benefits. But generally, this usually looks like more capital to invest. And again, I think we're still waiting to see what they're going to do with that additional cash. We do see that Verizon has been investing in growing their fiber footprint, and they are waiting on the Frontier transaction to close, which will give them a lot more reach into that broadband market.
Kelsey, we thank you so very much. That is Bloomberg's Kelsey Griffiths. And coming up in the next hour, we're going to be joined by Verizon CEO Hans Vestberg. And it's a big earnings week for big tech and the Magnificent Seven, Alphabet and Tesla. As we've been talking about, report on Wednesday with growth tested by economic headwinds and mixed earnings results from the other big players in AI. We're going to get the details now with Bloomberg Technology co-host Caroline Hyde. And there you see it. You have these two stocks that are down year to date, one more significantly than the other.
Yes.
When it comes to CapEx, how is this going to set the stage for the rest of how investors will perceive the Mag 7 results?
Well, when you're thinking CapEx, you're likely to see Bloomberg Intelligence thinking Alphabet's going to up it, maybe 10 to 15%. This is where the margin hit comes because they're fighting for AI talent. They are making these sort of weird acqui-hires that we've just seen being done with the likes of Windsurf with Alphabet, and they're having to explain the bang for the buck. Alphabet, you're likely to get it. Google is still managing to increase the cost of ads. You're likely to see a really good, then healthy number coming from ad search in particular. AI overviews has won out really well for them, so they're likely to price more against that. So you're likely to see revenue up about 12%. You're seeing earnings per share growth for Alphabet, even though, as you've seen from the share price so far this year, it's been a relatively unloved stock compared to the rest of the Mag 7, because in some ways it's seen as like an AI also ran, whereas really it needs to pack the punch that it's an AI winner. Whereas Tesla, I mean, boy, we know the deliveries have been ugly.
Right. We certainly do. And I'm thinking about Miller somewhere in Italy, thinking about that as well. I will say with Alphabet, I'm interested to hear about Waymo as well. That actually has the largest footprint of any robo-taxi operator in the U.S. That's one of Tesla's big bets. I'm interested to hear any update we get on the planned expansion there.
Well, when you think to Waymo, operating profit, it's not going to be dialing us up much overall. But yes, it is managing to, in the other bets department, probably drive up revenue by about 12%. They have scaled, they've showed it work. When you look at robo-taxis, this is where the proof needs to come in. Maybe we don't care the fact that revenue is going to sink yet again. The earnings per share is going to be down about 40% yet again for Tesla. Because Elon Musk, if he come out fighting, if he can come out and say, as he already is on X, I'm sleeping there, I'm there all day, every day. This is, you know, manic mode for him in particular. We are likely to see, therefore, maybe him galvanize his retail investor that, yes, the investments on robo-taxi future. Remember, he's promised it not going just to Austin, where they've only got a handful, what, 10, 12 cars. It's going to be in San Francisco in the next month or two. They've got their new futuristic diner. Don't know if you've just seen that opening in LA, Cybertruck boxes for the win. But this is all about marketing and trying to convince people that the amount of money that he spends on his data centers and indeed on more broadly the robo-taxi push out is going to be worth it in the longer term.
I'm glad you brought up the post that he made about sleeping in the office when he doesn't have his little kids with him. He posted that on Saturday. The shares are up a little bit this morning. A lot of people posting or pointing to that post because that's what shareholders really want. They want him focused on Tesla.
They want him back in the CEO role, focused purely on this. There's also, of course, we're questioning about the money going from Peter to pay Paul. Yes, they're going to ask Tesla shareholders longer term whether they want to put money into XAI. What is the dividend of doing that? Why does Tesla shareholder want to see money put from their own money pots into the future of large language model building for XAI? Well, because it feeds into robo-taxis. It's already going to be useful within Tesla. It's ultimately about really brand Elon once again. We know how much he can shake off anxiety by just saying he's back in full force, and certainly is trying to signal that on X. The question is whether the sleeping overnight is really going to pull out some of the sales and deliveries. Juniper Y, the new Model Y, the updated Y, is likely to have done relatively well. But remember, we're going to see a bit of a pull forward because of that pullback on the tax credits that you're likely to see by the end of September. People are going to race to get their cars ahead of that 7,500 coming off. But then what about the energy business? That's been a real winner for them. We'd like to see 50% growth, but is that going to go forward now that we know that the administration and the tax and the budget bill is pulling back from those sorts of subsidies and credits?
All right, Caroline, you have a busy week ahead of you. Great preview.
Remember IBM Wednesday too. It's going to be fun.
International Business Machines.
Busy
How could
2
I
weeks.
forget? Yeah, it's we're really in the sprint season here for big tech earnings. That is Caroline Hyde. She is the co-host of Bloomberg Tech. You can catch her at 11 a.m. But speaking of Tesla, automakers also releasing results this week, and you had Stellantis posting a brutal first half with a near $3 billion net loss. Restructuring expenses, waning sales, and U.S. tariff impacts all played a role in the prelim results. Bloomberg's Craig Trudell, he leads our global autos coverage. He joins us now. And Craig, I mean, I guess it's not surprising when you think about all the different cross currents coming at automakers right now, but still, some of these numbers, specifically with Stellantis, are pretty eye-opening.
Yeah, I mean, we just talked about, you know, Tesla and, you know, the EV outlook is very mixed right now as a result of some of the changes that we're seeing the Trump administration make. And that was one of the factors that you saw. Stellantis site here is essentially doing away with some product programs related to EVs and the undermining of the fuel economy standards in the U.S. You would think on the surface that would be a positive thing for Stellantis. They sell an awful lot of, you know, big Ram pickups and Jeep SUVs, but this was a company that was trying to really transition to an electric future and having real trouble doing so. So you have, you know, a real, you know, challenge and issues with making that jump, and sort of pullback by the company that, you know, this may come as some relief, you know, a year out from now, but for the time being, this is a lot of churn in their spending, and they're going to need to do some sort of taking of charges related to money already sunk into some of these bets that they're now going to have to take off the table.
Craig, we appreciate you keeping an eye on all of it for us. That is Craig Trudell of Bloomberg News. Now, more movers on our radar. Katie, you caught this one. Block is surging after news that it will replace Hess in the S&P 500. Of course, Hess closing that merger with Chevron, and Block was down about 14% this year. It's recouping a lot of that this morning.
Yeah, big time. A nice surprise there for Block. Shares rising mightily when you think about all that passive money that might come into it. Domino's also on the rise this morning. It topped sales growth expectations. Shares up a neat 4%, and I'm really excited to talk about Invesco. Invesco, it's a little bit higher this morning. It was up 15% on Friday, Shonali. That was its best day since 2022. For a really in-the-weeds reason, it filed to turn QQQ, it's their famous tech fund, from a unit investment trust into an open-ended ETF. I swear to God, that's exciting because
I read your newsletter on this.
Thank you.
It's a Monday, but still read her Friday newsletter
Yeah,
because it does have a lot of details on why that matters.
Yeah.
Money, a lot of money.
A lot of money, potentially hundreds of millions of dollars for Invesco that they currently don't collect, but we'll be talking about that later on in the hour. But coming up next, I'm pleased to say, Research Affiliates founder Rob Arnott, he joins us to break down a huge opportunity he sees in value stocks. This is Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
And now to high interest, a look at what's making headlines around the world. Taiwan's semiconductors market value closed above $1 trillion for the first time last week, driven by robust artificial intelligence demand. The stock surge reflects growing investor confidence that the world's top chipmaker will ride the AI boom to even greater dominance. And the biopharmaceutical company Sarepta is refusing to pause shipments of its medicine for a deadly muscle-wasting disease, despite a request from the FDA. 2 teenage boys died of acute liver failure in recent months after taking the treatment. Sarepta has lost about $8.5 billion in value since March 18th, when the first patient death was reported. And Microsoft servers have been hit by a large-scale cyber attack, with hackers exploiting a security loophole in the company's SharePoint systems. The Washington Post is reporting that the breach affected U.S. federal and state agencies, universities, and energy companies. And Katie, you do see Microsoft shares down almost 0.7% pre-market.
Yeah, a little bit of a drop there in Microsoft. We'll continue to follow that story. But let's zoom out a little bit and take a look at the broader universe, because our next guest says that historically cheap value value stocks are screaming opportunity as growth stocks get the spotlight. Rob Arnott of Research Affiliate says that, quote, if the value is dead narrative is even slightly wrong, value should perform brilliantly in the coming decade. Exactly the same argument can be applied for U.S. versus non-U.S. stocks and for U.S. large cap versus small cap stocks. I'm pleased to say that Rob joins us at the desk now. It's great to see you in person.
Wonderful to see you.
So I know you like asymmetrical bets. When it comes to value versus growth, it seems like, as you said, even this being slightly wrong would translate into big opportunity for you.
Yeah, the prices are set based on narratives. The narrative is that the Magnificent Seven will alter our world beyond recognition in the years ahead, that these companies will own the future, and that the owners of these companies have nothing but prosperity ahead. Narratives have the advantage of being largely right. These companies are going to rock our future. Shareholders in these companies are participating in that revolutionary change, but it's already in the price. And so that means if any of the seven were to fall short of expectations, the consequences can be unpleasant. This is how the dot-com bubble burst. The folks who coined the expression Magnificent Seven clearly never saw the movie. 4 of the 7 are dead at the end of the movie. And so do I want to pick which 4 of the 7 aren't going to be stellar in the coming decade? No, I do not. I want to look elsewhere for opportunity. And this is an opportunity-rich environment. I've been called a perma-bear. I'm a bull on things that are cheap and a bear on things that are frothy.
Well, let's talk about where value is working. We were looking at this chart this morning, and I thought I was hallucinating until Shonali reminded me that we're looking at the small cap universe. If you compare Russell 1000, we have the Russell 1000 value index. It should be the Russell 2000 value index versus the Russell 2000 growth index over the past several years. We'll get the chart up. But anyway, in the small cap universe, you do have value stocks outperforming growth stocks mightily over the past 5 years. I think a lot of people would be surprised by that. But does that just come down to the fact that you don't have those Magnificent Seven tech stocks or anything like them when it comes to the small cap universe?
The narrative takes hold when companies get noticed, and they rarely get noticed when they're small cap. So what we find right now is that Russell growth, for instance, is at nearly twice the valuation multiples of Russell value. Russell large cap growth is nearly 3 times the valuation multiples of Russell small cap value. And these spreads are at historic extremes. So looking at large cap growth versus small cap value, the spread is wider than it was at the top of the dot-com bubble. It's wider than it was at the trough of the COVID value meltdown in the summer of 2020. These valuation spreads are huge. Now the narrative is, forget value, these companies are toast, or many of them are. Here's a simple fact a lot of your viewers will find utterly shocking. The earnings for Russell 1000 growth have grown over the last century to date by 1% per year faster than the earnings for Russell value. 1%.
So what does this mean? Does it say more about the small cap universe than it does say anything about value and growth? Because to Katie's point earlier, you do see the S&P 500 growth index really outpacing that of value for, let's say, just, you know, I guess you could say normal sized stocks now, not just the small sized ones. And so are people worried about quality right now when it comes to things that are more leveraged, maybe less profitable?
We're doing some work on growth that I think is going to be making some big waves. People think you're a value guy. What are you focused on growth? No, we're fundamentals people. Fundamental index is based on fundamentals. Can you do the same thing with growth? Turns out, yes, you can. If you choose companies based on the rate of growth and then weight them based on the dollar magnitude of that growth, you wind up with a better growth index. And it turns out that, you know, some of these frothy growth stocks don't have spectacular 5-year earnings growth. It's pretty good, but it's not spectacular. And if you choose companies based on their underpinnings of growth, what is the 5-year growth rate in earnings, in sales, in spending on R&D? You wind up with a better growth index. But that's not where the screaming bargains are.
Right.
The screaming bargains are in non-U.S. stocks relative to U.S., non-U.S. value in particular, emerging markets value in particular, and small cap value versus large cap growth. Our work on developing capital markets expectations shows a 10-year outlook for small cap value of 8% per annum better than large cap growth.
Well, Rob, let's talk a little bit about just U.S. versus the rest of the world, because it's interesting to hear you say that that's still a bargain to go outside the U.S. Because we've seen quite an outperformance this year, and it feels like the first half of this year, people were saying this is a false dawn, it's not going to last, the U.S. is going to come back, and now you have a lot of folks saying, all right, well, I missed the rally. It seems like you're saying there's still room to run.
Oh, there's so much room to run. The room to run in large cap growth is a little doubtful. I mean, these companies have to exceed lofty expectations in order to outperform the market. And all you have to do outside of the U.S. and in U.S. small cap and U.S. value is exceed rather bleak expectations. Here's another fun factoid. I mentioned that Russell 1000 growth had earnings that were only slightly faster than Russell 1000 value over the century to date. Russell 1000 growth dividends have grown slower than Russell 1000 value dividends. So while the stocks of value have done terribly for quite a few years, the companies have done fine. Better than fine. They've done better than the growth stocks.
Speaking of waiting for value to catch up, when you pull up FTW on the Bloomberg terminal, these are factors to watch. You can see momentum outperforming much of what's out there.
Right.
I'm wondering who you could blame for the momentum. Is it the retail traders flooding the market? Is it the quant investors who are trading off the momentum? Is it the passive funds that are driving flows?
Yes, yes, and yes. All three of the above. Indexation itself has taken on a life of its own. It's half of the total market capitalization. Do a little thought experiment. Say it's 80% of the market. Index funds aren't passive. They do trade. 5% per year is the average turnover. That means they're 95% passive, 5% active. What's that active slice look like? They're buying frothy companies that are trading at lofty multiples. You don't fight it, you look for the opportunities that it creates. Because it's happening. Money's flowing in. When they have to buy a stock, it will be a frothy, high multiple company. And it'll replace a deeply out of favor, unloved company. That was the basis for our next concept. And if you go back historically, what you find is that the frothy companies then slightly underperform until they settle in to market-like valuations, and the unloved tend to bounce back. So looking for opportunities that are created by indexation can be very big. Now, thought experiment. 80% of the market is indexed. This could be the case in 8 or 10 years. That 5% turnover means 4 out of 80. For the other side of the market, it means 4 out of 20. That means that active managers have to be willing to sell 20% of what they own to the index funds, creating just stratospheric valuation spreads for the companies being added versus the companies being dropped. You can even do a thought experiment where it exceeds 100% of the plausible float. And in that case, the go-to price for the additions becomes infinite, and the go-to price for the sales becomes 0. Fascinating.
Yeah, we're going to noodle on that and so much more. You're sticking with us through the opening bell, I'm pleased to say, so don't go anywhere. We have much more coming up next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
All right, minutes away from the opening bell. Here's your setup. The S&P 500 slightly higher. Could today be another record? We'll talk through all of the action at the open coming up next. Don't go anywhere. Rob Arnott is back with us. This is Open Interest.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, we are moments away from the official start of trading on this Monday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. We know it's a consequential week when it comes to earnings. Verizon actually started off on a good note this week with a beat and raise quarter, but so did the financials last week. So did Netflix last week, and we saw the reaction there. This market has a very, very high bar. So it's all about the single stock stories this week, which is what we're going to be focused on bringing you. The bells are ringing over at the NASDAQ, over at the New York Stock Exchange. Maybe we get another record high on the S&P 500 today. Let's talk a little bit about some of the components that could get us there.
Yeah, if we get there, big tech might help. We have, of course, Tesla, Alphabet earnings later this week. Huge earnings week underway. Another big one next week, too. But Wednesday is when you see these two. Of course, they are both down on the year. But Google, Alphabet, trying to break back into green territory for the year, up about more than 1.2% at the market open. Tesla up more than 2%. Intel also up, Katie, before those earnings.
Those are the names that we need to behave this week. We'll, of course, bring you all the action there. Let's talk a little bit more about Verizon, though. It posted a surprise net loss of subscribers, but it raised its profit outlook, citing Trump's tax bill and its wireless price increases. Shares currently up about 3% or so. A reminder, we'll be speaking with the CEO at about 10:10 a.m. today. You don't want to miss that, but you don't want to miss this either. We're back with Research Affiliates Chairman and Founder Rob Arnott. And Rob, let's talk about earnings season a little bit and the reaction function that we've seen so far, because I mentioned the big banks last week posting really impressive numbers, not exactly seeing the reward. Then you saw Netflix coming out with really strong numbers, falling 5% on Friday. It seems like this market is a lot tougher than maybe it has been in seasons past.
This is what happens when you get a frothy bull market. And I'm on record suggesting that this is a bubble. Bubbles last until they don't. And so this is going to be interesting to see how it plays out. One other element that I think is really important, our CEO, Chris Brightman, has come out with a number of very interesting pieces that show that stimulus doesn't stimulate, that when it comes to fiscal stimulus, a lot of that comes back into corporate earnings. So every $1 trillion of incremental deficit spending leads to hundreds of billions of dollars of incremental corporate earnings. Just fascinating. And so the stimulus doesn't stimulate the economy. It does stimulate earnings, and it does stimulate, think of it as a fire hydrant open on a city street. The people who in the homes don't get any of the water. The people with buckets near the fire hydrants get all the water. Well, who's the people with the fire hydrants? Financial services and corporate America on the profit side.
So who benefits the most? Because you look at Verizon directly citing favorable tax reform as they increase their guidance. Are there places you're looking to see where that one big, beautiful bill is going to be impacting corporate America the most?
We haven't drilled down to that. I wish I had a good answer for you on that. Broadly, it'll impact corporate earnings in a big, beautiful way, and that can keep bubbles going longer. We saw that through the whole period of monetary ease with zero interest rates, where the zero interest rates sure didn't stimulate economic growth. Economic growth was kind of sluggish that decade, but it sure stimulated capital markets. And it's not a healthy form of incremental growth if it's rewarding share prices and not the broad public. So that's the big issue. That's the big divide.
Well, let's talk about bubbles a little bit more, because I feel like we're all kind of familiar with how bubbles form. You get some stimulus stimulating the capital markets. You get investors falling in love with a theme such as AI. But how do bubbles pop? What is the typical catalyst when you look across history?
Firstly, catalysts are, by definition, a surprise.
That's true. I was hoping you could just tell us.
It's still a fun parlor game to try to guess what they can be. Second, thought experiment. What were the catalysts that caused the dot-com bubble to burst in March of 2000? I have yet to hear a really powerful argument for what it was.
Right.
Maybe stock options coming up for expiration for redemption of shares, that sort of thing. But realistically, the catalyst can be almost anything. One catalyst can be earnings growing a little slower than expected. Another can be the economy faltering. Another can be a liquidity crisis in which people need access to their money, and all of a sudden those massive inflows into index funds become massive outflows because people need access to cash. What's the most liquid asset they've got? Their index funds.
Perhaps a catalyst, too, could be the Fed chair getting fired in some manner.
Well, that's where I was going to go next also. This whole idea of the pressure that President Trump has been putting on Fed Chair Powell. You think about liquid assets, U.S. bonds being among the most liquid of them. What's the perfect hedge? Do you recommend hedges right now? And is there anything in your portfolio that suggests that your clients are flocking to them?
Well, I think one question, and you've touched on this with some of your other guests today, is what's the next move for the Fed? And realistically, historically, the natural yield on short-term money is about 1% real. Okay, so if inflation is running 2.5, that means 3.5 is the go-to rate. One of your earlier guests also said that they thought that the 10-year ought to be at 5. Well, 3.5 on short money, 5 on 10-year money is a perfectly normal yield curve. And so moving in that direction is probably where we're headed. Now, I say where we're headed because, like gravity, the movement of interest rates towards a natural rate is entirely normal. It can be forestalled by enough pressure from central control. Japan's been practicing yield curve management for a couple of decades. Look where it's got them. Their macroeconomic growth has been negligible. So it's not the right thing to do, but it's an easy thing to do.
All right, Rob, we got to leave it there. Great to see you. Always appreciate you being so generous with your time. That is Rob Arnott. He is the chairman and founder of Research Affiliates. Let's get a check on this rally right now. This stock market in general, you're taking a look at the S&P 500 up about 0.3%. And I have some good news for you, and that's that breadth looks pretty good at this exact moment. You take a look at the gainers relative to the losers in the index, more than 300 names in the green, just under 200 in the red. And it's a lot of names that you would want to see leading gains right now. Apple higher, Meta, Alphabet ahead of earnings. Then you have Broadcom and Amazon in there as well. Tesla, too, ahead of earnings. That's going to be one of the more fun reports this week. But take a look at the downside, and you could get a little bit nervous about today's action because you have NVIDIA and Microsoft trading places right now for the biggest loser on a points basis. We're talking about small moves overall, but when we're talking about trillions of dollars in market cap, certainly those names have a big effect. So let's take a look at the sector levels and what the breakdown looks there as well. Again, more green than red. Up in the top, you have communication services. The biggest mover there is Verizon after its beat and raised quarter. The CEO coming up on open interest next hour. You take a look at the bottom, industrials, healthcare, and energy. Some of your small gainer or losers right now, Shonali.
And coming up next, we're going to talk about what you had identified a little earlier, Invesco wanting to reclassify QQQ so it could reap the benefits of one of the world's most popular ETFs. There's millions at stake for this ETF. We're going to talk about the details next. This is Bloomberg Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg. Welcome back to Open Interest. Let's take a look at this market right now and the rally that's underway. The S&P 500 up about 0.3%. You can see a lot of strength is coming from big tech, with the NASDAQ 100 higher by about 0.5% right now. We'll see if that holds through the big earnings week that we have ahead, with Tesla and Alphabet taking the stage this week. And shout out to the small caps as well. The Russell 2000 up about 0.5%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Dollar Tree getting upgraded to a buy over at Barclays. The firm says that it's positioned to benefit from a trade down by consumers, which will only accelerate. Next up, you have Morgan Stanley upgrading Pinterest and Etsy, citing improving macroeconomic trends. The analyst also cites Pinterest's attractive valuation. Take a look at shares right now, higher by about 2.5%. And finally, I am so excited for this. Invesco getting upgraded to a buy over at TD Cowen. The firm is calling its move to unlock fee revenue from the QQQ ETF a, quote, game-changing event. So let's discuss this news now with Bloomberg Intelligence financials analyst Neil Sipes. And Neil, I feel like this requires some explanation. So the QQQ ETF, it's actually a unit investment trust, which I swear to God is interesting. They're filing to turn it into an open-ended ETF, and that actually has huge consequences for Invesco, because in its current format, Invesco doesn't actually earn any fee revenue from this enormous fund.
Yeah, and that's right. And I think that's why you mentioned the enormous fund. That's why this is such a meaningful story here. For the past 20 plus years of the fund's existence, Invesco has, charged a 20 basis point expense ratio. All those fees are effectively pass-through fees onto third parties. One caveat there is 6 basis points of that 20 goes to a marketing budget for Invesco. So they really lean on that to sort of broaden the brand of Invesco. But in terms of a management fee, advisory fee, actual top-line support, pretty much zero here. So when you talk about the fund with, I think, north of $350 billion in assets, they're looking to sort of convert this into an ETF, charging a slightly lower 18 basis point fee rate. And so we'll kind of have to see what it looks like overall. But I mean, when you run the rough math, it's obviously quite meaningful to the business. We calculate about 7% of net revenue is what they can generate if they sort of net out fees that are similar to the QQQM which is actually sort of the clone ETF product
Right.
that they rolled out about 5 years ago.
Right, that was their answer to this dynamic where, okay, QQQ is very popular and it's just growing, but we don't make any money. Let's launch sort of a baby version of it. I want to talk about the specifics of what this could mean for Invesco a little bit more, because I did the napkin math, 20 basis points on $355 billion in assets. That translates into more than $700 million in annual revenue that they're missing out on. We won't know the exact revenue breakdown, how much of that goes to the index licensing, et cetera, but in terms of the boost that could give to the bottom line, just expand on your calculations a little bit more.
Yeah, and so I think when we look at QQQM, again, which is active in the marketplace as an ETF, it's about 50 billion versus the 350 billion in the unit investment trust. So when we look at that, about half of the 15 basis points is what they're netting to the top line. So if you kind of do that rough math, again, the earnings accretion is pretty meaningful here. And so I think going forward, it's going to be the question of how much do they retain some of that marketing budget. Obviously, that's going to eat into it a little bit, but it really does two things for Invesco. One, it meaningfully steps up that earnings sort of run rate as a normalized business, and it really steps up the organic growth potential, right? Because these are non-management fee earning flows that they have today. It's a product that's been growing double digits over the past probably 5 to 10 years, whatever time frame you look at. So that's going to be well received in the market. You saw it Friday with the 15% increase in the stock. In a world where traditional asset management is a little bit out of vogue, the ETFs still continue to produce the growth.
That's where I was going to go next. If you look at the stock of Invesco versus BlackRock this year, it's pretty interesting. You see it at double the pace. It's rising right now. It's up more than 15%. BlackRock is up less than 8%. BlackRock, of course, is a much bigger company. So the Qs, they've become synonymous with Invesco in a lot of ways. How important is it for them to capture this fee revenue?
I mean, I think it's pretty important, especially when you think about Invesco in the context of someone like BlackRock, where you look at the price to earnings multiples there, it's about half of BlackRock. And really the story with Invesco has been a pretty painful but necessary transition in asset management from the higher fee active products to the lower fee passive. And what we've really seen over the past 2 years with Invesco is a meaningful sort of re-rating in that organic growth. They've actually flipped to positive flows, some of the strongest in the industry. A lot of that is coming from the ETF and index franchise. So when you all of a sudden put their biggest fund and the most meaningful product that they have in the marketplace back into that franchise in terms of revenue generation, it's a meaningful story.
It's worth pointing out, too, that Invesco reports earnings tomorrow. Their call is at 9 a.m. So if you're not watching Open Interest, I would imagine that this is going to be a hot topic. Let's talk about how this actually goes through, because this is a proposal right now. They filed a proxy statement to shareholders on Thursday of last week. They're holding a special meeting on October 24th. They need a quorum of more than 50% of the holders of outstanding voting shares. That is a very tall hurdle to clear when you think about how many tens of thousands of shareholders the Qs have.
Yeah, and so they may be leaning on some third parties to help garner that support. I guess two things of note. One is the QQQ as it stands today, 20 basis point expense ratio. Through this proposal, they want to reduce it to 18 basis points. So that in some worlds should generate some shareholder interest, right? When you're lowering fees, that'll usually make your shareholders smile there. So that should help generate some interest. But, you know, I think we know that the QQQ has a pretty sizable retail investor holding as well. So sort of garnering the support of a lot of smaller retail investors, you may sort of need a lot of outreach and maybe need some third-party support there. But again, I think, you know, over time, we'll certainly be watching this. It's sort of a unique story in the space right now. We'll have to see if others follow suit and sort of follow how this proceeds. But certainly if it goes through, it's definitely a net positive.
Yeah, absolutely. It'll be fascinating to see how this one develops. I do want to pull up that table once again, the most profitable ETF. So it's ironic that the Qs are at the top and Invesco doesn't actually see much of that profit. You also have SPY up there as well, which is fascinating because this is in the same situation as the Qs. This is a unit investment trust, meaning that State Street itself doesn't really see much of that $577 million in annual fee revenue. Neil, I know you don't cover State Street, so I won't ask you about it, but really great insight here. Stay close. That is Neil Sipes of Bloomberg Intelligence. And don't miss ETF IQ today at noon right here on Bloomberg Television. State Street's Anna Paglia and Double Line's Jeffrey Sherman join the show. Now coming up, Figma and some of its investors are seeking to raise over $1 billion in an IPO. We'll bring you the details here next. This is Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Welcome back to Open Interest. Let's get a check on this rally because we have gains extending right now. If you take a look at the S&P 500, now higher by about 0.4%. We are above 6,300 on that index. And you have big tech really leading the way with the NASDAQ 100 higher by about 0.6%. We know that it is a busy week when it comes to earnings. A lot of big tech names reporting. You take a look at what has reported so far to my left here. You had Domino's earlier this morning. It was higher. Now it's lower. Verizon really holding on to its gains right now. And then you have some of the big tech names. Tesla up on the earnings stage. It's higher right now, too, but it's coming up this week. And we'll see if it follows the path of Stellantis, which was reporting some pretty hefty charges when it comes to some of those tariff impacts. Shanali.
Yeah, and in other news, we have IPO news coming as well. So companies not yet hitting the New York Stock Exchange or NYSE, but pretty close. Figma is one of them. The company and some of their investors are looking to raise just over $1 billion in an initial public offering. The software company has filed for a listing, which could see it valued at close to $13.6 billion. For more, we're joined by Bloomberg Equities Capital Markets reporter Anthony Hughes, and that $13.6 billion valuation is below the $20 billion that it could have gotten in a sale to Adobe. What does this say about valuations for the darlings that are about to hit the market?
Yeah, well, I think it's interesting because once you add in restricted stock units and options and the equivalent of options and the like, the valuation will be a bit higher than that, more like 16 billion, 16.5 billion. And I think over the next week or so, as the roadshow goes on, and this is a deal that's going to be pricing next week, next Wednesday, the July 30. There's going to be likely to be a lot of demand because this is a fairly scarce asset in a company that's growing 40% plus. the software sector hasn't been as busy in the last few years as it was in, say, 21. So the situation we have here is that this is somewhat of this is a big event for the software industry in the sense because this is an application software company that's going public, and there hasn't been very many of them in recent years, and this is going to be getting a pretty sporty valuation. Some of the software IPOs that we've seen in recent years have come at more like sort of around 10 times sales, whereas this one's going to be leaning a bit more on the valuation. And I think, you know, even though these numbers we're throwing around today are based on the terms that they've launched this morning, I think, you know, it could expand over the next week. Certainly the company will be hoping so.
So circle that date on your calendar, next Wednesday, July 30th. It's interesting to see just the pace pick up this summer. There's been no summer slump when it comes to the IPO market, and I still don't have a good sense of what is driving that. Is that we're past peak uncertainty? Is it just that traders and companies are tired of waiting so long to come out of that pipeline?
Yeah, well, it's been an interesting year in terms of the narrative for the IPO market because while it's been a fairly positive environment, we've seen some really strong outcomes, some strong debuts, particularly Circle, which was early last month. But we did have a big gap there in April where there were no IPOs, and we've had these disruptions associated with the spikes in volatility around the tariffs and the like. But overall, the environment's been very strong, and when IPOs have come to the market, the IPOs that have come have been quite well received and heavily oversubscribed. And you know, I think people are generally positive about the outlook, particularly after Labor Day. But normally the summer can slow down a bit. But here we've got a bit of a flurry of deals that's going to happen between, say, now and maybe the next 3 weeks, and then we'll have a break for August. But we're going to have 4 companies go public this week, 4 sizable companies, and then next week we'll have Figma, and we'll have another one too, so another one or two maybe.
Also, Katie, bullish that crypto exchange has also filed a lot of SPACs as well. So this is a market that is absorbing this while it can.
I'm glad you defined it because I was going to say, didn't you just launch the show and
I know.
going public as well?
I know, different going public.
Yeah, true. Anthony, great reporting. You're going to be very busy over the next week or so. That is Anthony Hughes of Bloomberg. And coming up in the next hour, we're joined by BlackRock's Gargi Chowdhury. She will be talking to us about earnings expectations, and then really excited too for our conversation with the CEO of Verizon.
Yeah, we'll also speak to Senator David McCormick after that big AI summit in Pennsylvania. Stick with us. This is Bloomberg Open Interest.
Villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A close call for about 80 people on a connection flight in the Midwest.
The pilot of a Delta flight from Minneapolis-St. Paul to Minot, North Dakota, got on the plane's intercom to tell passengers he had to avoid a B-52 bomber on the approach to the North Dakota airport.
Sorry about the aggressive maneuver. It caught me by surprise. This is not normal at all.
The pilot went on to say, quote, "Thank you for understanding. It was not a fun day at work." Passengers applauded the pilot. Jim Crisilla, CBS News.
A deadly plane crash in Bangladesh. Military officials there say a Chinese-made Air Force training aircraft slammed into a school in the capital of Dhaka, killing 19 people and injuring more than 100. Local reports say most of the victims were students. The cause of the crash is under investigation. Extreme heat warnings are up from Florida to the Dakotas today. CBS News meteorologist Andrew Kozak.
Millions and millions of folks across the midsection of the country and the south underneath excessive heat watches, warnings, and advisories.
A factor in the humidity, and it could feel like 109 in Memphis today and 102 in St. Louis. A federal judge in Louisville holds a sentencing hearing today for Brett Hankinson. He's a former police officer convicted of violating Breonna Taylor's civil rights in the botched drug raid that left her dead 5 years ago. The minimum penalty, just a day in prison. The maximum, life. CBS's Nicole Valdez.
We're really looking to see what the judge does here, if she will consider the Department of Justice's request or if she will go much steeper and look towards more of the maximum sentence in this case.
President Trump's administration may defy the courts. CBS's Vicki Barker.
Out of 160 court cases where a judge has issued a substantive ruling against the administration, President Trump and his appointees have defied a third of them. The Washington Post reports Justice Department lawyers and the agencies they represent are, quote, snubbing rulings, providing false information, failing to turn over evidence, quietly working around court orders, and inventing pretexts to carry out actions that have been blocked.
A family from the U.S. handed the Pope a T-shirt today reading, "Duh, Pope." And they got a special honor in return.
Oh, my gosh, you just got blessed by the Pope!
He blessed the Munoz family of Chicago as they were visiting Vatican City. The Dow's up 66 points in early trading. NASDAQ ahead 54. This is CBS News. An 11-year-old who survived deadly floods at her summer camp in Texas is making up a fundraiser for victims. KHOU TV's Marcelino Benito.
2 weeks ago, Cameron was at camp in the Hill Country, 19 miles from Camp Mystic. She made it home. So many did not.
I was like really, really sad, and I thought that could have been me.
The young baker decided to help.
How long did it take for that light to turn on?
We thought of cookies.
So for the last week, she's been mixing away, pouring hope and love into each and every dozen.
Over 1,000 cookies.
Permission to raise money for the Hill Country. It didn't take long before each batch became a movement.
A health update from Billy Joel. He tells Bill Maher's podcast.
It's not fixed. It's still being worked on. I feel fine.
Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. Lisa Mateo, alongside Paul Sweeney, we are here with you for the next couple hours of the Bloomberg Intelligence Radio program. Coming up, we've got a couple simulcasts we're going to do with Bloomberg Television. The first one is Verizon CEO Hans Vestberg. He's going to speak with Bloomberg anchors Shonali Baskett, Katie Greifeld. They just reported some numbers this morning. We'll break that down. We're also going to hear from Senator Dave McCormick of Pennsylvania. He'll be speaking with the folks at Bloomberg Television. We'll bring all that to you. Phil Orlando, Chief Market Strategist at Federated Hermes, will get his market call as well. We always appreciate checking in with Phil. But right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, guys, and this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. Treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Right now, records. S&P 500, 32 points higher, up 0.5%, 63.28. That's a record. The NASDAQ Composite Index up 155 points. That's a record. The NASDAQ 100 up 170 points. That's a record. Nice. The Dow, not a record, but still up 135 points right now. And, of course, earnings, the big focus. Companies accounting for about a fifth of the S&P 500's market cap expected to post results this week. Other include Tesla, Google's parent Alphabet on Wednesday, Lockheed Martin, and Coca-Cola. They report tomorrow. Max Kettner at HSBC says stocks can actually push even higher.
From a fundamental perspective, I think this rally can still go on a little bit further. I think equities still have, particularly in the US, a little bit room to run further, particularly with that reporting season. Let's remember that we're going into this reporting season with very, very low expectations.
Among the best performing stocks right now individually in the S&P 500, shares of Verizon Communications, they're up 3.2%, posting second quarter revenue surpassing analyst estimates. I also raised their profit outlook. At the same time, the company saw a net loss of 51,000 monthly wireless phone subscribers in the period. I can tell you, being a customer of Verizon, every day T-Mobile tries to contact me in some way and steal me. They've done everything except arrive at my house and offer to cook dinner for me and my family.
Would that be the deal breaker, though?
That could be the deal breaker.
Yep.
Verizon, you better ante up. Of course, the CEO
business
coming up, too. Yep. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Lisa and Paul.
Fantastic. John Tucker, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. As John is reporting, we've got green on the screen here. But let's take a look at some individual stocks here. I'm Paul Sweeney with Lisa Mateo. We're joined by Bloomberg's Christine Aquino. Christine, what are you looking at today?
Well, Paul, let's take a look at Microsoft. Ticker MSFT. We're not actually seeing big moves this morning. Shares are up 0.3%, reversing some of those earlier losses. But we did get big news about the company because we did see Microsoft warning that hackers are actively targeting customers of its document management software called SharePoint. And security researchers are flagging the risk of widespread breaches around the world. So apparently the U.S. Cybersecurity and Infrastructure Security Agency, that's a mouthful, isn't it? Warning on Sunday that the vulnerabilities in the software have allowed hackers to access file systems and execute code. Microsoft said over the weekend that it had released a new patch for customers to apply to their SharePoint servers, but they are still working out to roll out others to address ongoing security flaws.
If Microsoft's at risk, what's that mean for the rest of us? With our little passwords and maybe a fingerprint here or there.
I know, and there's so many different passwords. Trying to remember all them two at the same time.
It is. I mean, again, I think cybersecurity is the growth business for the next 50 years. I mean, every day it seems like that risk is out there. All right, what else you got for us?
Looking at Equinix today as well, Paul, ticker EQIX. That stock doing well today, up 2%. So just bearing some of those opening gains that we saw, but still going strong. It's a data center operator, and they're getting a boost because Elliott Investment Management apparently built up its stake in a company. That is according to people with knowledge of the matter. And Elliott is now one of the company's top 10 investors. It owns about 0.2% of the company and is pushing it to take steps to boost its share price. So remember, Equinix market value around $76 billion. It has fallen more than 16% this year. Last month, it suffered its worst one-day drop since March 2020 because the company revealed higher than expected capital expenditure at an analyst day. So CapEx, that's really a big sticking point for a lot of these AI-related stocks, right? And so if Elliott is getting involved in pushing the company to really improve its books, then you would expect them to focus on that.
This is a REIT that focuses on data center stuff. So generally speaking, it's a part of the REIT business that people like, all the tech stuff and the data
definitely a
centers
hot business
and all that kind of stuff.
Yeah.
Interesting. Okay.
Well, it's funny. She said, I was like, Equinox, the gym? No,
Equinix. So I went to BICO to see which Bloomberg Intelligence analyst covers it. It's Jeff Langbaum, our REIT guy. And, he likes the business, but obviously there's been some missteps there. So, all right.
Got to go to the last one.
Got to go to Domino's.
Yeah, but their shares are lower. They had some pretty good results, though.
Yeah, exactly, Lisa. So earlier it was up, but now shares are down 2%. I mean, the kicker there is really comp sales growth, right? That's what analysts liked earlier on in the session. That came to 3.4% versus an estimate of just over 2%. Bernstein analysts saying that their stronger than expected second quarter results suggest that a strategy centered around innovation, which is primarily their stuffed crust, and convenience could offset more than General's consumer softness. But that consumer softness still very much a part of their analyst call. They did say that second quarter results continue to be hurt by a challenging macro backdrop. But that stuffed crust really driving market share catalyst, apparently.
That's awesome.
I don't know. I'm not a big of the stuffed crust. Too much dough for me. I don't know. Too much dough.
Any sign of the Spicoli effect in these earnings?
Hold up, right. So what John's referring to is the weed, the greater use of cannabis as it becomes more and more legalized. Does that have a positive impact on
munchies?
pizzas?
Is that what you're talking about?
Munchies.
Specifically the layer, that lava cake.
Would you have personal experience?
Stoners love it.
People were definitely making that call when cannabis has been more widely, legalized across the country.
Right.
What's that mean for fast food delivery, pizza, all that kind of stuff?
This is all according to third-hand information, though. None of us have first-hand experience with it.
It's still the same time. Well, GLP-1s are like hot too, so
offset that. Good point.
I mean, I don't know. It's a back and forth, but here in the area, I mean, we got good pizza. You said that before.
Yeah. So I mean, that's the thing. I mean, here in the greater New York City area, including way up to what a lot of people say is the pizza heaven, which is New Haven, Connecticut. That whole area, we've got world-class pizza here. So Domino's kind of tough to compete here, although I see it everywhere. But in the rest of the world where they don't have the really good pizza, Domino's is a great option.
And they have the DoorDash and the Uber Eats, too, on top of that. So that really helps out.
Right. So when was the last time you had a Domino's, though, at least?
College. That was a long time ago.
Christine?
That sounds appropriate. I can't even tell you.
No, and John, he's just got no way.
All I have to say is it's really a gourmet's delight stuff.
Yep.
Domino's.
Right, but for a lot of people, it's the bomb. So we'll see how it goes. I mean, when I went to college in Richmond, Virginia, or Durham, North Carolina, it was Pizza Hut, Domino's.
Yeah.
Pizza. That's basically
That's all you have.
That's all you kind of had.
Well, that's where they got the stuffed crust from.
Yeah, is that
Pizza
right?
Hut.
Is that right? Rolling on that. All right, Christina Kino, thank you so much. We appreciate that. Coming up, we're going to check in with the CEO of Verizon. You know, when I follow the cable industry, it seems like, you know, the cable companies and the telcos, the Verizons, the AT&Ts, they are just in each other's backyard. Cable companies offer, you know, cellular telephone, wireless telephone. Now the telcos are offering broadband into your home, competing with the Comcasts of the world. So they're just in each other's backyard. So competitive. It's all in prices. John was just saying, you know, really,
all the offers.
I've been a Verizon wireless person just since the beginning of cellular telephone, and I've never switched.
Right.
I don't know.
I've got my AT&T. It's been
But
a
I know
long time.
a lot of people switch all the time for the best deals.
I can't. It's too much work.
Yeah. I don't know. So I'm looking at Verizon stocks up here today, but it's a tough call. But that's why, you know, you look at some of these telco names. It's not necessarily an earnings growth story, but boy, they've got a 6.4% dividend yield. So maybe it's low single digit growth, but you know, you do get that dividend yield that kind of pops it up there. So right now we got Verizon trading up today on the news. Verizon CEO Hans Vestberg sitting down with Bloomberg Television anchors Shonali Bassett, Katie Greifeld. We're going to talk about the business, going to talk about maybe the competition, the competitive market, not just with the other telcos, but also with the big cable TV companies. Let's go to this conversation right now.
Welcome now our Bloomberg Television audience and radio listeners. Verizon stock rising after beating revenue estimates and raising its profit outlook. Joining us now, Verizon CEO Hans Vestberg. Question about your revenue guidance here and the beat that you have posted so far. How much of a role did the recent price increases play in the quarter's performance?
No, if you look at the quarter, I mean, and actually the last 4 quarters, our strategy is working. We have a lot of vectors of growth all the way from our broadband, fixed wireless access, our step-ups, prepaid is growing, and then we have our adjacent services with perks and all of that. So all of them are actually contributing. And then the last, I would say, 3-4 quarters have also been very good and disciplined on our cost levels. So we get the leverage. So our EBITDA was $12.8 billion, a growth of 4%. So we raised the guidance both for EBITDA, EPS, and free cash flow. All of them sort of coming from generation of good financials. But it's based on the customer offerings we have built over the last year. That is really resonating with the market, either on broadband or wireless. And for all customers, we're serving all customers in the United States, all the way from the governmental or federal customers to large enterprise, SMBs, and consumers. So that's what you see right now resonating with the financials, but ultimately it's about having the right offerings for our customers.
Well, let's talk about those cost levers a little bit more when it comes to wireless, because, okay, you had a net loss of 51,000 monthly wireless phone subscribers in the period. Analysts had been expecting a gain, actually, of about 12,000. At the same time, you did have those wireless price increases go through. How many more times can you pull that lever and continue to raise prices?
I think we had a price increase on consumer postpaid in the first quarter that has been lingering to the second quarter. I never disclosed my commercial strategies going forward, but I think we have a good value, we have a good proposition, and we have an enormous good value on the consumer side. But you cannot forget our business side, where enterprise and SMBs are continuing the growth for us, both in wireless and broadband. Overall, in the quarter, we had more than 300,000 new customers coming in at the same time as we gain in efficiency.
So what does this mean for the progress and the path to restoring growth in phone subscribers?
So if you look at the quarter again, we had 300,000 new customers coming in on wireless and broadband. We are building the network once, that's a strategy, and then getting as many profitable connections on top of it. So this quarter was 300,000 again. So that's why we are growing our business at the moment. And we had the first half year, our service revenue, which we are measured on, is growing 2.4%. The overall revenue was growing 5% this quarter, way over 34 billion, was driven by a lot of upgrades on phones. loans. So we have growth in our business right now, and we're getting leverage on that because we have 4% growth on EBITDA, we have 6% growth on EPS. So clearly that is falling through and in efficiency work. So we are very focused on the growth. We have many vectors of growth, but also we are very financially disciplined how we spend that money to grow that customer base.
Curious to talk a little bit here about what you're seeing in the big, beautiful bill, because you cited favorable tax reform as one of the things to be optimistic about. So walk us through specifically what benefits you see there from tax reform and how that translates into the next quarter, into the year ahead, for example.
Yeah, so when it comes to the bill that was passed, I mean, there was one piece that is very important for Verizon. That's, of course, the depreciation we can do directly on our capital investment. That have this year an impact of $1.5 billion, $2 billion on our free cash flow. So it's significant. Together with our operation, our cash flow from operation that is improving, that's why we increased our guidance with almost $2 billion in the quarter compared to the financial guidance we had from the beginning of the year. So that's one piece of the bill. The other piece of the bill is, of course, that the government wants to auction out spectrum again. Verizon is in a great position of spectrum today, but you know, over the time, as we as a country want to be the most digitalized country in the world, spectrum needs to come out for 6G and other technologies going forward. So we're very encouraged to see that as well. It's going to take time before that spectrum comes out for auction, but it's good that the government are thinking long term in this area.
On tax impacts in particular, you know, your earnings are perhaps the more obvious first set of glaring results that show you a benefit immediately. But is this kind of a one-time benefit, or do you see some sort of ripple effect that comes out of that big, beautiful bill for you and maybe even the rest of corporate America, frankly?
So the tax benefit has not impacted our financials yet. That's going to be in the second half and then going into next year because it's a perpetual sort of benefit we have. So that will continue. So, but I think for us, we are very disciplined with our capital. We already increased our capital for 2025 compared to 2024. Now we have our Frontier acquisition pending. We're waiting for the last approvals here. When that comes in, of course, we're going to make a holistic view how we're going to do capital allocation going forward. But always we put first priority in the business. Number two, we have increased our dividend 18 consecutive years, and we're going to put our board in a position to do that. And then we pay down our debt to get our leverage ratio. And after that, including Frontier, we're also going to come to buybacks. We're going to package that in the next couple of months and talk to the market how we see about capital allocation and the benefits of incorporating Frontier when that's approved.
Well, Hans, keep in touch as you make progress there. Great to get some time with you on what I know is a busy morning. That is Hans Vestberg of Verizon.
All right, Verizon CEO Hans Vestberg. Speaking with Bloomberg Television anchors Shonali Bassick and Katie Greifeld, Verizon put up some pretty decent numbers. The stock's up 4% today. And then, as Mr. Vestberg was talking about, they've got a dividend that's north of 6%. So that kind of gets your attention in a business that is a relatively slow growth business there. So good interview with Mr. Vestberg. Right now, let's get a reset here. We'll go to John Tucker in a Bloomberg Business Flash. John.
All right, guys, this Bloomberg Business Flash being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. The start of a busy week for corporate earnings, sending stocks to fresh records. The S&P 500 up 35. That's up 0.6%. 63.32. Never been there before. Right now, the Nasdaq Composite Index had a record 21,069. The Nasdaq 100 up 186 points. That's a record. Dow Jones Industrial Average 145 points higher right now. That is up 0.3%. Shares of Microsoft, they are actually higher right now, up 0.2%. But a worldwide cyber attack underway after hackers took advantage of a security flaw in their server software. The cybersecurity experts say they're seeing attempts to exploit thousands of SharePoint servers globally. Stellantis, they make Jeep SUVs and Fiat cars, announcing a surprise $2.7 billion first half net loss. Analysts had expected a small profit. Yeah, in the stores, you know what? They got the pumpkin stuff out for Halloween already. And Starbucks has announced that its pumpkin spice latte is going to return to store menus August 26th. I can't wait. Can't wait for the opportunity to pay how much for a cup of coffee? You get free.
If you get the big one, it's probably about $8.
Oh, Lord. Anyway, we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Lisa and Paul.
All right, John Tucker, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, and we're also streaming live on YouTube. You can head over to youtube.com, search Bloomberg Live Radio, and that's where you'll find us here. You know, a lot of the news that's been building over the last several days involves the Federal Reserve and its chairman, Jay Powell, and how secure is his job? What does President Trump really want to do there? What can he do there? And what does that mean for financial markets? So that's just another issue for investors to get a handle on in space of lots of economic data coming out, as well as we're right smack in the middle of the earnings season. So let's check in with a professional who does this stuff for a living, Phil Orlando, Chief Equity Market Strategist and Head of the Client Portfolio Management at Federated Hermes. Phil, this is something that the market hasn't really had to deal with ever, I don't think, president exerting this type of pressure on a Federal Reserve chairman who's presumably fully independent of the White House. When you talk to your clients, how do you position that potential risk?
Well, first of all, Paul, thank you very much for having me on again. You know, I'm not sure that this is as unprecedented as people would think. We just know more about it because it's out there with, you know, a 24-hour news cycle and all the tweeting and whatever. But, you know, you go back to, you know, the Nixon era, the Carter era, the LBJ era, whatever, and there were tensions between the White House and the central bank in those periods too. But it's clearly unprecedented now, I think, because of the explosion of media attention. What we're telling our clients, though, is that I don't want to say much ado about nothing, because certainly there's risk. But when the dust settles, we don't think that the Trump administration is going to do the wrong thing and fire Jay Powell prematurely. The reality is that Powell's term doesn't expire until May of next year. We believe that central bank independence is absolutely sacrosanct, and I think that Treasury Secretary Scott Bessent and the head of the National Economic Council, Kevin Hassett, are explaining to the president that he needs to focus on the things that he can control, you know, keeping economic growth strong, bringing inflation down, and lower interest rates will follow naturally by the central bank. So just leave the Fed alone, let them do their thing.
Hey, Phil, I want to talk about earnings because last week's earnings really helped drive the S&P 500 to new highs. We have more this week. We got Alphabet and Tesla on tap. So have you been impressed so far with corporate earnings, and what do you think moving forward?
In a word, the answer is yes. Now, we're early in the season, Lisa. You know, we're 10 to 15% in. But, you know, revenues so far are up about 5.5%. The consensus was that that number was going to be, you know, up around 4%. And earnings so far are up about 12%. Consensus was that earnings this year are going to be up 5%. So we are absolutely impressed. Again, it's early. About 19% of the S&P 500 is going to report earnings this week on a market cap basis. So this will be an important week. But the financials, I think, did a really nice job. You know, J.P. Morgan and others getting out of the gate in pretty good shape. And I think the usual tendency of management sort of, you know, setting the bar low, sandbagging the quarter, going in, and then having, you know, manufacturing upside surprises. I think this is another in a long list of quarters in which managements have, you know, been able to successfully achieve that.
So, Phil, August 1st is going to be potentially a big day in the tariff narrative. It's a day President Trump is kind of laid out there. Again, we've seen these things be pushed back before, but boy, if those tariffs really go in August 1st, those are some big numbers for a lot of our trading partners. Are you a little concerned that maybe the market's a little complacent about maybe lingering tariff risk?
So 2 points, Paul. Great question, by the way. Number one, I think the situation is fluid. You know, we thought we had our hands around this on Liberation Day, and then that got pushed out to July 9th, and then it got pushed out to August 1st, and then we've heard that maybe it get pushed out to Labor Day, and you know, someone over the weekend said even if we have the tariff situation on August 1st or Labor Day, we'll keep talking, we'll keep negotiating. You know, so I don't know that we've got a hard stop here. I think it's a very fluid situation. But certainly, from the perspective of the market, we're up. The S&P 500 has rebounded by almost 31% in the space of the last 3.5 months. So, and we're entering, you know, what is historically the seasonally the choppiest, most volatile period. So, could something stupid happen that causes an air pocket for stocks, at least temporarily, at some point during the August-September time period? Absolutely. So what we've, you know, cautioned clients, he said, look, we've got a very fundamentally positive longer-term view. We think stocks are going to be at 6,500 by the end of the year. But we've also rallied to 6,300 here, you know, over the course of the last 3.5 months. So could we have a little bit of indigestion? Could we pull back 5%, 8% or whatever temporarily, and then reassert ourselves going into the end of the year? That's an absolutely plausible scenario, and we've presented that to clients.
Now, we've been talking about some of the challenges. What's one trend you think the market is underestimating right now?
Well, I think what they're underestimating is the longer-term positive impact of fiscal policy initiatives on economic growth and corporate earnings growth. You know, one of the things that our macro policy committee, we had our last meeting about 2 weeks ago, our GDP forecast for next year, full year calendar 26, is 2.8% GDP growth for the S&P for the U.S. economy. The consensus blue chip number is literally half that at 1.4%, and the high on the street within the blue chip group is 2%. And so, Lisa, you ask yourself, what's causing that divergence? I think the answer, very simply, is through what prism are you looking at fiscal policy developments? Are you looking at them through a Keynesian prism or a supply side prism? And you end up with extraordinarily different results depending upon what school of thought you were brought up in terms of your graduate education or your PhD or whatever. So we're more supply-siders. We think growth is going to be better 18 months from now than the average investor is looking at.
So given that backdrop here, are there certain things that screen well for you guys?
Absolutely. Areas that have been left behind, industrials, financials, healthcare, utilities. We think there's still value left. We had thrown some more money at technology and domestic large cap growth, back in April after that 21% decline. That's worked pretty well. And we think that there's a big trade coming with small cap, which has lagged large cap, for most of the year. We think there's a catch up coming that'll probably start later in the year, but because that tends to move quickly, our feeling is that we need a position ahead of time.
Now, Phil, how are your clients reacting to all of this? I mean, mixed eco data, tariffs, right? Are they staying invested? And then what are you telling them?
So we've encouraged them to stay invested. The knee-jerk reaction is the average investor is apoplectic with all of the twists and turns that you just expressed, Lisa. And the average end client is saying, all right, cash me out. I want to invest in gold, ammunition, canned goods, and I'm going to hang out in the bunker in my basement until we've got this all figured out. What we're trying to do is encourage them that that's exactly the wrong position, that the longer-term view is going to work out. You don't have the luxury of being out of the market, because when the market moves, it's going to move quickly, and so you've just got to watch your allocation, perhaps position a little more defensively if you're nervous. Have a balanced allocation, have some small cap, have some international, have some value, have some dividends in there, and all of this will work out over time. But being, in cash 100%, as you look at the vicissitudes of what's going on in the market, you would have just missed a 30% rally. And that's exactly the wrong thing to do.
Phil, great stuff as always. Always appreciate getting your time. Phil Orlando, Chief Equity Market Strategist, and he's also head of the Client Portfolio Management Group at Federated Hermes. Appreciate getting his thoughts here. Lisa, you highlighted a really interesting article here. It's from our friends over at Bankrate.com. Kind of America's best states to retire in 2025.
Yeah.
And they kind of looked at some things like affordability, weather, safety, healthcare, that kind of stuff. I wouldn't have picked these names, but the best, you tell me, the best states to retire: New Hampshire.
Can you think of the New Hampshire?
Maine.
I never thought of
New
it.
Hampshire's number one, then Maine, Wyoming, Vermont, and Idaho. The worst states, 50 through 46, Louisiana, Texas, surprisingly, Oklahoma, Arkansas, and Nebraska. I don't see Florida there.
I was going to say, are you going to be on a beach in Jersey still, or what are you going to do?
Well, here's we just decided, a couple years ago, we're staying in Jersey.
Okay.
Jersey's short. Kind of April through October, there's no place in the world we'd rather be. And the rest of the year, we'll travel a little bit, and and that'll kind of be it. But I mean, I wouldn't have thought of these states. But again, you look at the ones, their affordability.
Correct. I would think Florida be more affordable than like a New Hampshire. I don't know.
I don't know. Interesting. So there you go. But I mean, weather, I can't imagine the weather in New Hampshire and Maine, Wyoming, Vermont being, I don't know. Those winters
that's
are
what
tough.
my mom left here and went to Florida because she wanted the weather a little bit better.
That's what everybody does, I thought. And then Texas not ranking well, but
entertainment and other things too.
Yep. All right. So we'll see. I'm staying put here. I don't know about. John Tucker's probably on the first train down to Florida, but anyway. All right, coming up in just a moment, Senator Dave McCormick of Pennsylvania will be speaking with Bloomberg Television. We'll get his thoughts. We've got the midterms coming up, like in a year. It's the folks down in D.C., particularly the congressmen, every 2 years they have to run. So it seems like they're perpetually in campaign re-election mode. So, but then there's a lot of policy that needs to be, and a lot of legislation that needs to be passed. So there's a lot on the plate for our good friends down in Washington and D.C. S&P 500 up 35, Dow up 137, NASDAQ up 175. So green on the screen here. We'll keep an eye on the markets here. Big week for earnings. Right now, let's go to Bloomberg Television. Anchors Shonali Basak and Katie Greifeld with Senator Dave McCormick of the Commonwealth of Pennsylvania.
Just taken place, and we welcome now our Bloomberg Television and radio audiences. President Trump was in Pittsburgh last week at a summit that was led by Republican Senator Dave McCormick. Dozens of top executives attended the event with the goal of making the Keystone State a hotbed for energy and AI innovation. Joining us now to talk about the initiative is Senator Dave McCormick himself. Now, you had so many companies there, of course, many large investors, both investing in data centers as well as these big hyperscalers themselves, and also commitments to jobs. What was said outside of the public eye a little bit, Senator? Can you tell us about the jobs that might be created in the state, maybe above and beyond the things you've heard from GE Vernova, for example, Google with dollars that they would be putting into the state? What else can happen?
Well, good morning. Thanks for having me. It was really an historic day. Right after I won the election, I talked to President Trump, and I suggested that it'd be great for him to come to Pittsburgh, where we could talk about the crossroads of the AI revolution, the energy revolution. Pittsburgh and Pennsylvania is really at the center of both revolutions. We have the second largest energy production in the country. We have bountiful natural gas, fourth largest reserves in the world, incredible skilled workforce that you just referred to, incredible technology universities. Carnegie Mellon is where we hosted this. And the president agreed to do it, but honestly, it exceeded my expectation. We had CEOs from the major investment firms. Blackstone made a $25 billion commitment. We had big energy CEOs. We had the hyperscalers, as you said. We had global investors, the CEO of GIC, the CEO of Mubadala, the CEO of the Canadian Pension Plan, all to think about how Pennsylvania can be at the forefront of this incredible revolution. We had $92 billion of investment that was announced, about $36 billion in data centers, about $50 billion in energy infrastructure and production. That's transmission, that's distribution, that's a transition from coal to natural gas in a number of places. So this is the beginning of something very special, and I guess this is absolutely going to create tens of thousands of construction jobs, thousands of permanent jobs. But I think the most important thing was not the announcements of the day, but 150 media people that were there that allowed us to tell Pennsylvania's story. This is just the beginning. The Emirates was there, United Arab Emirates, Haldoun Al Bamarik from the UAE. My wife and I, Dina, we had just been in the Emirates. We had talked to Sheikh Mohammed, the Crown Prince, or the leader, and he had mentioned the commitment he had made to President Trump to invest $1.4 trillion in the United States over the next 10 years. Think about that, $140 billion a year. So the $92 billion is a lot, but it's just the beginning.
Senator, there's the money involved, there are the firms that would be involved in building more AI infrastructure, but then there are the rules and the regulations. What is your office doing to tear down red tape when it comes to energy infrastructure, and how might that be mimicked across the country? You're looking at Governor Kathy Hochul here in New York as well, looking to make nuclear power a bigger part of the story that follows the 3 Mile Island announcements last year. Right. What's going to change?
Well, there needs to be permitting reform at both the national level, the federal level, as well as the state level. And the thing about this incredible moment is this should be a bipartisan moment. So I did an event the night before the summit with Senator Fetterman in front of 300 energy executives. Governor Josh Shapiro was at the summit. He and I did a panel together with Amazon, which has committed $20 billion to Pennsylvania. That's in addition to the $92 billion. So we need permitting reform at both the federal level and at the state level. And listen, politics is politics. We're going to have lots of disagreements with Democrats as Republicans, but energy dominance and taking leadership in Pennsylvania at the forefront of these incredible changes, I hope that's something we can agree on. And permitting reform is the key. I'm on the Energy Committee. I'm the chairman of the Energy Subcommittee. And when we get back from the August recess, we're going to turn to permitting reform.
Let's keep talking about nuclear, because if you take a look into the future, I mean, how does this landscape actually develop? Do you see modular nuclear reactors going up around the country? What are you doing specifically to bring them to Pennsylvania, perhaps?
Yeah, I do. And one of the great announcements at the summit was the iconic Westinghouse Corporation announced that it was going to build 10 nuclear reactors over the next 10 years. And that's huge. That's the rebirth of nuclear power in the United States. And of course, there's all sorts of new technologies around modular reactors. The CEO of Westinghouse, when he was on the CEO panel that we had in Pittsburgh, said that one of the main reasons for that was the executive order that President Trump had put in place. This is one dimension of energy dominance, to embrace nuclear power. I've sponsored legislation with Senator Coons, a Democrat from Delaware, on the need to embrace nuclear power. So it's got to be a mind shift. Permitting reform is a critical part of it. It's a longer cycle to get these nuclear reactors up and running. But what's already happening in Pennsylvania, we have a huge installed base. Constellation, the biggest nuclear provider in the country. 3 Mile Island was just, a deal was just done with Microsoft to create power for Microsoft data centers. We've got the Limerick plant, which is going to get refurbished. So there's two dimensions, or maybe three dimensions. There's refurbishment of existing facilities to lengthen their lifespan. There's the traditional big reactors that are going to be built in Pennsylvania. And then I think there's next generation modular reactors, which offer real opportunity.
So, Senator, energy, of course, as evidenced by the fact that we're talking about nuclear, it's a broad church here, but then you consider wind, you consider solar, maybe some of those clean energy sectors that it seems like President Trump has really been de-emphasizing, if you want to call it that. Why not take a holistic approach here?
Well, listen, he has said, and I've said, that I support all forms of energy. So I'm in favor. One of the deals that was announced was the deal between Brookfield and Google on refurbishing some of the hydro facilities in Pennsylvania. So I embrace all forms. I think where the difference is that President Biden had hundreds of billions of dollars of subsidies for some of these clean energy alternatives, and President Trump was opposed to that, and I was opposed to that because it was one of the drivers of inflation. We should let the market rule. Great innovations happening with the market, and the problem with wind and solar, it can be part of the answer, but it's very intermittent compared to the baseline power capacity of natural gas, of nuclear power, of coal. And so to meet the energy demand we have about a expectation of about tripling the demand for energy over the next 15 years, we're going to need strong, consistent baseload power. So wind and solar can contribute, but it's never going to be the core of the answer.
Senator, before you were the senator of the great state of Pennsylvania, where I also went to school myself, you were also the CEO of what was long been the world's largest hedge fund. I'd love for you to weigh in here on what's happening between the White House and the Federal Reserve, because a lot of market watchers are looking at this and questioning what this means for the central bank's credibility. What would you like to see happen ultimately, and do you also think that the Fed's credibility is at stake here?
Well, I think President Trump has made clear that he has no plan or expectation of firing Chairman Powell. I think it's a long-held tradition that presidents often critique the conduct of the Fed chair, so that's not new behavior. The president's going to have a chance to put his imprint on the Federal Reserve with 3 appointments in 2026, 2 Fed governors and the chairman, and I think he's going to do that. And listen, what's happening in the economy is really noteworthy here. I think the worries about an inflationary pulse as a result of tariffs are not coming to fruition, so I'm hopeful that we're going to have a rate cut in the future. And if you're President Trump, think about it this way. It's like driving the economy is like driving an aircraft carrier. All the great things that are happening, energy dominance, deregulation, the big beautiful bill and what it means for permanent tax cuts, pro-growth economic policy. The one thing that's still a struggle for working families is high interest rates. And so the president's very focused on delivering on his promises to working families, as am I. And that's why interest rates are such a big deal. It's hard to finance a home. We've got home prices that are way up in Pennsylvania. So this is all part of making sure that the president delivers on his agenda, and I'm confident that with the policies we're putting in place, that's going to happen.
Senator David McCormick of Pennsylvania, we thank you so much for joining us here on Bloomberg Open Interest. Thank you very much. Now coming up.
All right, that was Senator David McCormick of Pennsylvania, speaking with Bloomberg Television anchor Shonali Bassik and Katie Greifeld, talking about the energy policy coming out of this administration, the energy needs, which, as the senator said, a lot of folks think they could triple over the next 15 to 20 years, driven in part by the increasing demand and deployment of AI and the data that's required there. All right, right now, let's get a little bit of a reset. We'll go to John Tucker for a Bloomberg Business Flash.
All right, day of records as we get a flood of corporate earnings, and the results so far show a beat of what were pretty much lowered expectations to begin with. S&P 500 at a record up 32 points, 63.29 in the index. The Nasdaq 100 up 174 points. That's a record. And the Nasdaq Composite Index, also record territory there, up 159 points. Dow Jones Industrial Average 141 points higher, and that is up 0.3%. If shares of Verizon Communications 4% higher, helping lead the way, the company reporting stronger profit for the latest quarter than analysts had expected, along with higher revenue than forecast, and they also raised their forecast. It is the second best performer right now in the S&P 500, behind the Hershey Company of Pennsylvania. Domino's Pizza reporting a profit for the spring quarter, coming up short of analyst expectations. Meantime, Lori Calvasina at RBC Capital Markets says, you know what, the tariff-related inflation threat, don't forget about that. It's still there.
Companies are doing their best to mitigate what they can. They're working through a lot of pre-tariff inventory, so it's going to take longer for those impacts to show up. And I think investors, have gotten sort of a sense that we're kind of in the clear, and I don't think that we're in the clear yet. I think this is going to be, a little bit of a messy situation, manageable but messy.
As far as treasuries, the yields on the benchmark, the 10-year, 6 basis points lower. That's at 4.35. The 2-year yield, 2 basis points lower, and that is at 3.84. The new Oakley Meta HSTN glasses, that's actually pronounced Houston, start at $399 and climb to $500 for the limited edition gold mirror lenses for these glasses. Nice. The technology inside is actually almost identical to Meta's Ray-Ban spectacles, and they retail for only $299.
And what do we do with these things?
You put them on and look stupid.
No,
you get to surf, and whatever.
All right.
All sorts of cool things.
I have seen people with them on.
Have you?
It's a little crazy. Yeah. Like the whole weird goggles, I call them.
Okay. Are they recording you when they look at you?
Now I'm like self-conscious. What
It is Lisa Mateo, a superstar of Bloomberg Radio. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Lisa and Paul.
All right, John Tucker, thank you so much. We appreciate that. Lisa, what's the softball schedule these days? Are we summer softball?
We are summer softball, so we're all in. I think last weekend was Pennsylvania. We have Maryland. I'll be off next week because I'll be in Maryland.
Oh.
For a softball tournament.
You're taking valuable
I'm taking
time
valuable
off
company time.
to go to a softball tournament?
Because I love my daughter and I will support her as far as it goes, even if it's to Maryland.
All right. So, I mean, I guess, don't we have teams in New Jersey? This whole travel thing gets me.
It's a little crazy. And you go all the way to Maryland and then you play teams from New Jersey. So it makes no sense.
It's a scam. This whole travel thing, I'm convinced is a scam.
It's a lot. It's a business.
It is a business.
Very big
and
business.
And it's a business. Who did I hear? It was one of the hotel, big, like Hilton.
Yeah.
They say they have a whole line, I don't know, maybe it's Hilton Gardens or something like that, that they kind of started that because all these travel teams there was such demand for just basic, low-cost, and they know where to put them. They know to put them next to these athletic facilities. Right.
Next to anything fun. I know the moms and dads are listening. You're feeling my pain. I know you are.
But the worst, I think, for travel sports is hockey. The stories I hear from hockey parents, I mean, they go to Canada. That's expensive. They go to Ohio. I mean, they're going
that gear is not cheap.
Yeah, and the gear's not, so I'm glad my kids never got
You
into
escaped that, too.
I did.
You escaped that.
And
you escaped
Disney.
the dog and Disney.
Yeah, I'm paying for it now. With
and now you have
Seamus.
the dog.
Yep, exactly. All right, we got the markets higher this morning. We're going to have more coming up. We're going to have Sam Fazeli talk a little healthcare. This is Bloomberg.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, right, it is time to talk biotech. You're joining us here on Bloomberg Intelligence. Lisa Mateo alongside Paul Sweeney. Who better to go to about this topic than Sam Fazeli? He is Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals. Joining us in from London. Sam, thank you for joining us. I want to start with gene therapy because of that story out today that the FDA said that Sarepta Therapeutics, they refused to stop those shipments of his experimental gene therapy. So what does this mean for the industry?
Yeah, so first I wanted to say, Lisa, that unfortunately this is a product that's out there to help young boys with Duchenne muscular dystrophy. It's a devastating disease, and it's very sad that there is a risk that the one hope that they had, we could talk about how good a hope it was later, is at risk of being pulled off the market. I can't imagine a parent who's not sitting there with a child that's got DMD and not in despair. The flip side of it is that there have been 3 deaths associated, 2 of them directly with this product and 1 with a product that uses the same delivery technology. So whilst the hope is real, and there are anecdotal stories and real stories of boys who are doing well on this product, so is also the deaths that we've seen. So this is a very tough balancing act for the company and for the regulator. And the way this came out to be is that the data that wasn't good enough for the regulator a year ago or so to approve it, but one of the chief regulator, Peter Marks, pushed it through and got it approved, which is all perfect as long as safety is not compromised, and now we're worrying about that. Of course, there are nuances here, but that's where the balance of story is at the minute. And what does it mean for gene therapy? Well, of course, it's going to mean questions, and every technology that or product that uses this platform specifically is going to be under the lens.
So what does this signal, if anything, Sam, about the FDA and how it's viewing various maybe drugs or therapies that are already in the market?
Yeah, but so Paul, this is all that story with regards to its approval, very similar to the Alzheimer's drug story, where the panel of the experts they put together said, don't approve it. And the regulator said, we want to approve it, and it's approved. And of course, nobody wants to use it now. It's the same story, but it's the previous administration's team. Now we have a new team in charge. Interestingly, the head of that regulatory division, the Center for Biologics, is Vinay Prasad, who was very critical of the FDA's decision to approve this DMD Duchenne drug a year ago, or before. So it would be interesting to see how this pans out. But I think the pull is very strong from parents who have no other choice. And, you know, we're all around this conversation, parents, and we know what that means. There are lots of risks that you would buy when you're dealing with a totally fatal disease, although it might take a year or 2 or 3 to manifest. So a very, very difficult balancing act here.
Sam, I want to touch on another topic, longevity wellness biotech. I mean, when David Rubenstein launches a new monthly program on longevity, it's got to be big, right? So is it really that big?
Well, so look, we have a very clear increase. Perhaps there have been a little dip. It's because of COVID, etc., in the ability of folks to live longer and longer and longer. What these groups, and there is another group that I came across last week that I'm looking forward to talking to more, human longevity. These are groups that are trying to find ways of not just making you live longer. I think the anti-cancer drugs do that, right? But making the quality of your life better, keeping you more productive. And in a world where, let's say, fertility rates are going down, there's 2 ways you can save us. Through people working longer and healthier lives, having healthier lives, and probably AI, but we'll see how that pans out. You can't, I don't see any other way if this fertility rate issue continues to be a problem.
Sam, what's the latest from your industry, the big pharma industry, the biotech industry, as it relates to tariffs? Do we have any more clarity than we did maybe a couple of weeks ago?
No more news since last week. But, you know, companies are starting to report, Paul. And a couple of them started, at least we know that Johnson & Johnson last week, after the last time we spoke, they did reduce their tariff impact from $400 million to $200 million. And what we're going to see more of is that they all say they're in constructive dialogue with the administration about this. And so perhaps, we keep hearing soon there's going to be tariffs, We're not seeing it, we're not hearing it. I'm assuming that people are treating all these threats the same as every other threat that the administration puts out, i.e. not believing it until it happens. So nothing new aside from what the companies have said so far, which is constructive discussion.
Very good. We'll hear more, hopefully, from this upcoming earnings season when the companies speak to the marketplace. Sam Fazeli, he's the Director of Research for Global Industries and a Senior Pharmaceuticals Analyst for Bloomberg Intelligence. He is based in London, has a grievous shoulder injury, torn rotator cuff, reportedly from opening a bottle of Bordeaux.
I would think so.
That's kind of how that goes. It's a tough business out there. So markets we have green on the screen here. S&P's up 0.5%, the Dow's up 1/3%, and the Nasdaq's up 0.8%. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now with markets higher. Look at the yield space here. 10-year Treasury, it's in almost 6 basis points. We're down to 4.35% on your 10-year. WTI crude oil off a little bit, now just below $67 per barrel. Bitcoin, it's higher for Tom on the Upper East Side. A quote there, 118,000.
This is Bloomberg Intelligence with Paul Sweeney.
The semiconductor business is a really cyclical business. The market's telling me, here's another AI play. Just bid it, buy it. Is the market over their skis? Are people just too exuberant out there?
Breaking market headlines and corporate news from across the globe.
This was a big success story for Apple.
We like bonds. We think bonds are attractive.
Private markets have become very diverse.
What we're telling people is be cautious here.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up in this hour, we're going to talk to John Butler, Bloomberg Intelligence. He's the senior telecom analyst. We'll get his thoughts on those Verizon earnings. We heard from the Verizon CEO in the last hour. This hour, we'll get the analyst view. Anurag Rana, Bloomberg Intelligence technology analyst. He's going to join us. We got a lot of tech stuff to talk about. I want to ask him about Microsoft. How can a company like Microsoft, with all their know-how and technology and resources, how can they get hacked? I mean, what's that mean for the rest of us? I'm not sure how much my little password's going to hold up against some cyber criminals. Adam Kuhn's chief portfolio manager with Winthrop Capital Management. We'll get his market call here. Max Chafkin, Bloomberg Business Week senior reporter. He's got some more stuff on Elon Musk. How about this title? Elon Musk's empire is creaking under the strain of his antics. That should be interesting. So a lot coming up in this hour. Let's kick it off. John Tucker, Bloomberg Business Flash.
All right, guys, the major stock averages setting new records as earnings season moves into full swing this week. The S&P 500, by the way, is trading 22 times its expected 12-month profits. You have Tesla and Google parent Alphabet. They're due to report results this week. Traders are going to look for updates on artificial intelligence spending in particular. Right now, you have 9 of the 11 major index groups in the S&P 500 up, with communication services in the lead, and that is home to Verizon. Meantime, Troy Gajewski at FS Investment Solutions sees another leg up for stocks at the same time that the concerns are building.
Most likely outcome is a continued grind higher. The only cautionary tale now, which is a little bit different than 2 weeks ago, 4 weeks ago, 6 weeks ago, 2 years ago, is we're back to highly extended valuations.
Microsoft shares right now, they're actually up just over 0.1%. They've warned that hackers are actively targeting customers of its document management software, SharePoint. Security researchers have flagged the risk of potentially widespread breaches around the world. Right now, the S&P 500 up 34 points. That's a record at 6331 on the index. The NASDAQ 100 up 168 points. That's a record. The NASDAQ Composite Index up 155 points. That's a record. And right now, the Dow Jones Industrial Average, it's up. It's not a record, though, up 170 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Lisa and Paul.
All right. Thank you, John Tucker. Let's take a look at some of the stocks on the move today. I'm Lisa Mateo alongside Paul Sweeney, and we are joined by Bloomberg's Christine Aquino. Christine, so we heard from the CEO of Verizon in the last hour. Shares higher, probably up about 4%. So digging a little bit deeper for this.
Let's take a look at it, Lisa. So yeah, Verizon, ticker VZ. Shares are still going strong this morning, up 4.5% now, so extending some of those earlier gains. And it really was that operating revenue beat, right? $34.5 billion, up 5% from the year earlier, and also exceeding those estimates for $33.76 billion. And then, of course, their full year forecast upgraded that as well by the company. Adjusted EPS now seen at +1% to +3%. Previously, the company saw that flat to +3%. So just a little bit of an upgrade there in terms of their outlook. And then, of course, we did hear from Verizon CEO citing their momentum and that the fact that they have a clear path forward. I think one focus for analysts, of course, is that consumer number, right? It's a minus 51,000 consumer number, postpaid phone customers. Now, that is actually better than the consensus of minus 87,600, but it's not great, right? And I think that's kind of what analysts are focusing on. Bloomberg Intelligence, though, saying that, you know, that number, the fact that it did slightly better on that figure suggests that the company is on track to post positive net additions for the year. Let's just see if they manage to keep John Tucker or if he succumbs to their competitors.
Ante up, you know, competition is fierce.
He can be bought. All right, how about Dollar Tree?
Yeah, Dollar Tree also doing well this morning. So ticker DLTR. Shares are up more than 2% now, so really accelerating those gains. Now, it did get a couple of great analyst moves overnight. So we did see the shares upgraded to overweight from equal weight at Barclays. Analyst Seth Sigman writing that after it sold Family Dollar, Dollar Tree is now a cleaner growth story and has strong momentum in the first quarter. That's accelerating in the second quarter, which sets it up well for the rest of the year. Its price target also boosted at JP Morgan to 138 from 111 previously. So 111, that's in line now with its current share price. 138 is a street high. And the JP Morgan analyst Matthew Boss saying that his recent fieldwork suggests there's potential incremental upside driven by the strength of the base business.
All right, Christina, I love a good target run, but the shares, they're not getting some love this morning. They're lower.
Exactly, Lisa. Dow, no 0.4%, ticker TGT. And so the same Barclays analyst, Seth Sigman, cut the stock to underweight from equal weight. And he's saying that there is value in the target model, but sales will continue to underperform without a bigger strategic shift. And so the macro environment, of course, not looking great for them. Inflation is just starting to accelerate. Remember, also last week, we did see Target saying that it will end a long-standing program that matches prices of items with those of its competitors. So not looking great on the competition front, you know?
All right, Christina Aquino, thank you so much. For more conversations like this, you can subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else you listen. All right, well, earlier this morning, Verizon CEO Hans Vestberg, he talked to Bloomberg Sonali Basak about some of the things that the company is doing right now. They just had their earnings report, but now we want to get the analyst view on that. So for that, we'll bring in John Butler. He's Bloomberg Intelligence Senior Telecom Analyst on these Verizon earnings. So, John, good beat, second quarter revenue, raised the profit outlook. What's making the company so optimistic?
So, I would characterize, when I look at Verizon, I think of the phrase game of inches, right? I think the improvements here quarter in and quarter out are incrementally better. They're edging towards that acquisition of Frontier, which is really going to change the game for them. But in the meantime, they put a lot of changes in place in terms of their go-to-market strategy, how they're combating promotions coming from T-Mobile and AT&T. And on the margin, quarter in and quarter out, I just see them doing a better and better job. I think all the actions they've taken are starting to work. And so taking the long view here, I really think Verizon is improving just quarter in and quarter out. And this was another quarter where you could look at it in isolation and say, you know, it was a solid quarter, a little bit mixed on some of the metrics, but I think on balance, better than last quarter and last year.
John, what's kind of the positioning of Verizon in the marketplace? Like, I've been a longtime Verizon wireless customer since the beginning of cellular service, actually, and I guess I was initially drawn to it because I thought they had the best network, so quality. Is that still the case? Because it seems like, I don't know, T-Mobile's gotten a lot better in quality, and AT&T, I don't know.
Yeah, you know, Paul, you bring up a good point. I think there's a question mark out there as to whether Verizon still has the best network versus T-Mobile and AT&T. But I think they have a slight edge there in terms of coverage. And it's interesting, a lot of people ask me about wireless, who has the best network, who should I choose? And the one thing that people are always asked about is how's their coverage? I think coverage is very important to people. And I think when you think on that metric, in terms of that metric, Verizon delivers the bars on your smartphone probably more than T-Mobile and AT&T. In terms of download speeds, though, I suspect that T-Mobile probably is gaining the edge here.
Now, what about prices? Did Verizon increase their prices? If so, did that help?
So we did see all the carriers are increasing prices right now. As the market matures and new user growth is slowing considerably, the only way you're going to grow that important service revenue metric is by raising prices. They tend to do it on older plans. Verizon's done it over the past 6 months, as if you look over the past year, so has AT&T and T-Mobile. That's flowing through and it's helping to boost the service revenue. I think over time they're adding in those little extras like, you know, device insurance and perks like, you know, added content that you can purchase at a discount through Verizon. And I think all that together is going to continue to provide a lift to service revenue. It's nothing special. Again, I'm looking forward to that Frontier acquisition where they're going to buy, you know, access to 2 million fiber broadband subscribers and 8 million fiber homes passed, because once they get Frontier under the hood, they're going to be able to bundle their wireless service with fiber. And I think that's going to help to really drive renewed subscriber growth.
So, John, use of cash here, how do they kind of allocate it between debt reduction? They've got a lot of debt on their balance sheet versus funding that big, juicy 6% plus dividend yield.
So they're doing both, Paul. I think free cash flow is going to get a lift from HR1, the new tax legislation. It's also a very cash flow rich business. As we exit the year this year, they'll have most of their cell sites upgraded with the new C-band, mid-band spectrum, which again is improving network speeds and enhancing their coverage. So that whole project is going to begin to wind down a bit as we get to year end. So they'll be able to sort of maintain spending without having to increase it, which is constructive to free cash flow growth.
All right, John, thanks so much. We appreciate it. As always, John Butler, Senior Telecom Analyst for Bloomberg Intelligence. Stay in the TMT space, if you will. We're going to check in with Anurag Rani. He's a Bloomberg Senior Tech Analyst for Bloomberg Intelligence. Anurag, you know Microsoft as well as anybody. Put into context for us this cybersecurity attack. It's been certainly at the top of the news here this morning, and it just kind of, I think, at least to me, is surprising that a company with the resources and the technology expertise of Microsoft, that they could, in fact, still be subject to this type of risk. How should we think about it?
Yeah, Paul, when it comes to almost all the major tech companies, this is probably the most important and, biggest risk for them. And again, whether it's Microsoft or Amazon or Google, this is one of the biggest worries for all of us is, you wake up one morning and you see a big outage out there. I mean, almost a year ago, we remember that CrowdStrike problem and what it did to, airports and all the other things. Now, but in this particular case, I think it's a lot less problematic than what we saw a year ago. This is primarily based on certain on-premise
software. I mean, there is an on-premise version of SharePoint software that they have. It's only affecting those particular workloads, so it's not as widespread as some of the other areas we have seen.
Now, what does this mean for cybersecurity companies?
I mean, it's a good thing for them. They are, I mean, to be honest, over the last 15 years that I can remember, they're probably the one area. It doesn't matter what the macro environment is. They continue to grow, bigger and bigger. That's because there's so many little nuances that have to be protected. These networks have multiple software from multiple vendors. And a lot of these companies do some unique things, go prevent them, endpoint security, analytics, you name it. I mean, there is no shortage of, I would say, funding for a lot of those companies.
So how do you characterize, or how do investors characterize just cyber crime risk for some of the big tech names that, the Mag 7 names, or just the big tech names in general? It's something that we don't really talk about too often, do we?
No, and in fact, as I said, I mean, I've always said that this is probably the biggest risk that faces all of us. Because remember, think about it, like AWS takes care of a lot of startups right now. You see a problem with that network, the rest of them goes down. Same thing you could say with Google's cloud platform, Microsoft's cloud platform. This particular incident is only for the on-premise application. So, in a roundabout way, maybe this helps Microsoft in the long run, that those customers say, you know what, I need to move online, I need to move more workloads to the cloud. But in totality, I mean, you look at it from a cyber insurance point of view, insurance companies don't even want to go down that route. I mean, this is one of the biggest hidden risks for all of us, especially as most of our savings are, digital and placed in not in safe boxes, but in investments somewhere digitally.
And Anurag, in the tech space, we also had some IPO news. You had Figma looking to raise about $1 billion U.S. IPO. What is Figma? What do they do? What's their market value?
Yeah, I was, this is probably one of the more interesting companies that I have come across in a long while. A few years ago, Adobe made a run for them, paid $20 billion to buy them. That deal didn't go through. Adobe ended up paying Figma $1 billion as for a breakup fee, but now they're going public. It's a very unique software in their market. What they do, nobody else does it so well. They help you design application all the way from ideation to publishing applications, or you could say issuing applications out there for people. So we want a whiteboard. You want to discuss this idea with the team. Phenomenal software. It has very high market share. And at this point, to be honest, Adobe had one product that had some overlap with them. But frankly speaking, there isn't a large company out there that's a credible competitor for them. So we think this is going to be an area where see strong interest. We anticipate sales growth north of 40%, both for this year and next year. We think revenue could be $1.6 billion by the end of next year. And our analysis indicates a post-deal valuation somewhere between, 19 and $23 billion, or 21 billion at the midpoint.
And this proposed stock symbol for this pending IPO is FIG. Bankers are Morgan Stanley, Goldman Sachs, Allen & Company, and JP Morgan. So the blue chippers there for that deal. And Anurag, in your software space, we've had a couple of pretty good deals this year. Circle Internet Group, CoreWeave. I mean, do you expect more?
I think if you have the capacity to go out in this market and raise capital, this is really good. Valuations are very nice right now. I mean, I would strongly encourage if there is somebody who's looking at it. But at the same time, there is an issue about, do you want to go and see your work being scrutinized? Public funding is also very good. There is so much private capital out there. So it really depends on what somebody is doing. Last year, we saw an IPO came out, ServiceTitan, and just in the first 2 months or first 2 quarters of their coming out as an IPO, they actually saw demand go because people recognize what this company is. I think the same could happen to Figma when, a lot of people don't know what these guys do. And, that recognizes the value of the software or the company just by going public.
All right, very good. Anurag Rana, Senior Technology Analyst, Bloomberg Intelligence. He's in our Chicago bureau talking about a little bit about Microsoft. They got the cyber security issue that it is dealing with. Plus, we got some IPOs in the software space picking back up. It's always a good sign here. Coming up, we're going to check in with Adam Coons. He's a Chief Portfolio Manager at Winthrop Capital Management. Get his thoughts on these markets. And then Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Manager. We're talking about Stellantis taking a $2.7 billion loss. So that is tough right there for Stellantis. as it deals with the evolution to electric vehicles. S&P 500 still higher by 0.5%. The Nasdaq's up about 0.7%. So we got some pretty solid gains in the equity space. Yields they come in at 10-year Treasuries in about 6 basis points, 4.35%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Now, you have companies accounting for about a fifth of the S&P 500's market capitalization. They're expected to post their earnings results this week. They include Tesla and Google parent Alphabet. That comes Wednesday. You have Lockheed Martin and Coca-Cola. They're going to report tomorrow. Right now, we're at records as we get the bulk of the earnings. S&P 500, 35 points higher. That is up 0.6%, 63.32 on the index. The Nasdaq 100 up 165. That's up 0.7%. That's a record. And the NASDAQ Composite Index also at a record, up 148 points. Dow Jones Industrial Average, that's up 207 points. That's up about 0.5% right now. Shares of Verizon Communications up 4.25%. The company reporting second quarter results. They beat expectations. They also raised the profit outlook. It is among the best performing stocks in the S&P 500, the second best performer right now. Analysts at H.C. Wainwright slashing their price target on Sarepta Therapeutics to 0. This cut comes as the drug maker is refusing to voluntarily pause shipments of its lead therapy, as follows a request by the FDA after 3 deaths were linked to the company's gene therapies, which target the devastating disease Duchenne muscular dystrophy. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Lisa and Paul.
All right, John Tucker, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube as well. As John Tucker was just reporting, all-time high here, all-time high there. It's like the whole tariff thing never happened. Is the market too complacent here about the risks that may be out there? Let's ask a pro that question. Adam Coons, Chief Portfolio Manager, Winthrop Capital Management. Adam, what do you think here? Are we a little bit of a FOMO market here? We're just kind of saying, you know, tariffs, schmariffs, who cares?
I mean, it certainly feels like that. There's obviously other things going on too, right? I mean, we've had some pretty big conflicts overseas. We've got a potential changing of the Fed, and it seems unlikely that we're done with kind of the tariff back and forth. So for us to be back at all-time highs and just kind of, like you said, just business as usual doesn't really feel right from a risk management standpoint. In particular, when you look at the fact that kind of valuations, it's not like through this cycle valuations suddenly just cheapened up. So for us, it kind of feels like the first of the year all over again, Groundhog Day, where we're at this point where markets just look overextended, whether you're looking at credit markets or equity markets. And so just the risk to reward just is out of favor right now.
So will the economy continue to grow? What pace are we talking? Because we're starting to see, evidence consumers, businesses who kind of held back during the spring, they're starting to spend again.
Yeah, they are. And I think that could lead to an uptick where we're kind of maybe moving more towards that, 3% type growth, a number which by no means is something to get excited about. But we know markets move more on, expectations and then whether it's upside or downside. So, those are the things that are obviously pushing the market right now is that hope, that thought that we will actually get more growth and actually see, growth that exceeds inflation. And then the hope obviously is that inflation doesn't quickly catch up and surpass growth. So right now, the economy is obviously doing well. The jobs market is still fairly sound. We see cracks here and there, but as a whole, employment is strong enough. The economy is strong enough. So there's obviously nothing out there that's going to kind of push the U.S. into a recession right now. So there's nothing that I think should be doom or gloom by any means. So I don't think investors should be moving to the sidelines. I think you should just be reconsidering, kind of the risk profile overall.
Fixed income, Adam, how does that fit into our portfolio these days, given some of the economic conditions, maybe given some of the valuations in the equity market?
Yeah, when that plays right into kind of my point on being slightly more defensive, in that we do like fixed income here. We've liked it all year long, honestly, as a risk mitigator, in particular because that is one area of the market where we see the risk reward asymmetry more kind of in our favor, in the sense that if interest rates don't move. And obviously we've got this kind of battle where the Fed is saying they're not, in a hurry to cut rates, and we have the administration in D.C. saying we should cut rates significantly. But take it at face value that the base case is rates really don't move much. I'm happy to continue to clip, above 5% in corporate bonds and high-grade corporate bonds for the foreseeable future. And then, if we do see interest rates come down, I would love to see that, obviously, appreciation of bonds. And you can pull out your ruler and do the whole, yields up, prices down scenario.
Yep, I'm keen.
Yeah. But so when you look at those are our two high probability scenarios, there's really a very low likelihood that rates go meaningfully higher from here unless we saw some drastic acceleration in inflation, and we're just not modeling that. We don't see the case for a drastic reacceleration of inflation. So for us, that's, like I said, it's the trade where you can kind of get that 5% expected return, kind of weather through this a little bit, see what happens in DC, and then maybe then you can put more equity risk on. But for us right now, the fixed income is the place to have, you know, an overweight.
Adam, are there any overlooked areas of the market that you think are gaining some momentum?
Well, you know, I guess probably something that's overlooked in the sense that kind of the inverse of that is that, you know, international stocks have outperformed U.S. for the first time in what feels like 20 years, but they've had a fantastic run this year. That exodus of the dollar was meaningful. And for us, we saw that as the opportunity on how we could kind of reinvest into U.S. stocks because, you know, we were equal weight international coming into the year. With that kind of outperformance, we've used that to reallocate to U.S. Stocks because that outperformance, that gap, we do not think is sustainable. I don't think the rest of the world, even with some fiscal stimulus, can survive if the U.S. economy rolls over, and especially if we say the U.S. economy is not going to roll over. I think you'll see those capital flows come back to the U.S., and you're already seeing, obviously, they were all-time highs. So that's just kind of an area where we don't hear enough people talking about it, and for us, we would be now well underweight international stocks to be overweight U.S. right now.
Adam, thanks so much. Always appreciate getting your perspective there. Adam Coons, Winthrop Capital Management. We like to check in with Adam there, Chief Portfolio Manager there, based in Indianapolis, Indiana. Let's go back to the car business. And we talk about a name we don't talk, I don't think, enough about, or as much as maybe we could, and that is Stellantis. Think about the old Chrysler with Fiat and all that kind of stuff. I'm not sure what all the brands are there, but they took a $2.7 billion charge here. Steve Mann, our Global Autos and Industrials Research Analyst for Bloomberg Intelligence, he joins us here. Steve, what's going on with our friends at Stellantis?
Yeah, so they reported the preliminary first half numbers today. They booked a loss and a charge of $3.3 billion. A lot of that is, you know, canceling the fuel cell R&D business. They're canceling like an EV for Maserati, taking some other charges on recalls and tariffs. Overall, at the end of the day, I think if you listen to the call, there's really no new bad news, which is good news for the company. I don't think it can get any worse. So, and that's why the stock's actually reacting positively at the moment.
Steve, what about the president's efforts to dial back the support for EVs? Is that affecting them as well?
You know, they are revisiting the EV business, not dialing back, not so much in Europe, but revisiting it, definitely in North America. And one thing that it's really bad for the quarter for them was really their North American business. Their North American business drives most of the profit. Shipments were down 25% in the first half, year on year. And a lot of that is controllable. One of the things, a couple of things that they are doing to kind of arrest that decline is not only cutting back on production, but they're relaunching a couple of popular models that they've discontinued. One of them is the Jeep Cherokee. It's going to come back later this year. And more importantly, to stop market share loss on their Ram trucks is they're going to reintroduce the V8. So, you know, they delayed, they didn't really say cancel, but they delayed the EV product for the Ram trucks. But now reintroducing the V8, which is, you know, the biggest engines you can get for a gasoline engine you can get on a truck.
So where is Stellantis in the world of big auto? How do they position themselves? I think about Ford, GM, Volkswagen, the Chinese players. I'm just not sure where to put Stellantis these days.
Yeah, I think, I mean, they do have an important role to play in the auto market. They're really strong in Europe, particularly in their, what they call the B and C segment, which is the hatchback, the compact, subcompact segment. They also have really high market share in their commercial vehicle business. This is like their Ram Transit van that you see, you know, a lot of contractors use. You know, they have 30% market share in Europe. And then again, Ram truck is one of the most popular pickup trucks in the U.S. market. Unfortunately, you know, Ford and GM has taken share from them because they didn't have the V8 when they, you know, talked about EVs and more fuel-efficient trucks. But, you know, the U.S. market is quite different. Commercial users do love the power, the torque, so they're reintroducing the V8 just to try to gain more market share back.
And they have a new CEO, Antonio Filosa. He's in office for roughly a month, so he's just getting there. What are some of the top items on his agenda? Has he talked about it?
No, but we'll hear more about it on July 29th. So today's call was just a preliminary call on first half. We're going to hear from the new CEO on the 29th, and I think a lot of the questions still in the air is, you know, what is the strategic direction for the company in terms of EVs? How are they going to manage the tariffs, which is still a big unknown because, you know, negotiation is still ongoing with Europe. And then, you know, what are they going to do with some of the kind of slower performing brands like Maserati, which is really draining a lot of their cash.
All right, Steve, thanks so much. Appreciate that. Global Autos research analyst for Bloomberg Intelligence. I'm looking at Stellantis, the shares trading in Milan, down 36% year to date. So tough on $23 billion euro market cap. So, you know, it's small relative to a lot of the other large global providers. You just don't know kind of where they fit in. And to me, the big question for all these autos companies is, how do they proceed with their EV business? I mean, they're not making any money. It doesn't seem like the support is there like it used to be from the government. So it's almost like, and I think what Steve would tell you is, what he's told us in the past is, it's still coming, but it's just going to take longer.
And that's exactly what he was saying. I'm a Jeep girl, and they have the electric Jeep coming out, and I see a lot of those on the streets.
Ah, you're a Jeep?
We do, with the whole Jeep wave and everything. Yes,
nice.
It's a lot of work.
Exactly. We're learning so much, John, about our Lisa Mateo Jeep. There is a sign for Vespa, people.
What's that?
You just kind of put this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, we're at records for most of the major indexes as earnings season kicks into high gear. Here's the report card so far. Just about 14% of the S&P 500's market cap has reported second quarter results so far. 83% have beaten earnings per share estimates. So that probably suggests that the consensus bar was set a little too low. Meantime, Bob Michael at JP Morgan says, you know what, tariffs are going higher. Their impact has yet to be felt.
It feels like the administration is solving for a higher tariff level, dare I say, to go from $2.8 trillion to something closer to what the One Big Beautiful Bill Act is, $3.4 trillion, so there's that perfect offset.
Well, the S&P 500 right now at a record up 37 points, 63.34 at the index. The NASDAQ Composite Index 155 points higher. That puts it at a record. The NASDAQ 100 up 179 points. That's at a record. The Dow right now up 237 points, 44,576. Microsoft warning hackers actively targeting customers of its document management software. This is a SharePoint, with security researchers flagging the risk of potentially widespread breaches around the world. Energy right now, the worst performing industry group in the S&P 500. Gas producers and energy-related shares. This includes EQT, which actually is the worst performer in the S&P 500 right now, tracking natural gas futures lower, and blame the weather. The forecast for a late July shifting to a bit cooler. So production of natural gas continues to run high. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Lisa and Paul.
All right, John Tucker, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. All right, we all know that Tesla is a volatile stock, but if you just look at the stock since, 4 years ago, so July of 2021, Tesla on a compounded annual basis returned you 10.8%, pretty good. S&P 500 returned you 11.4%. So it's kind of just in line with the broader market over the last 4 years. And there's some questions about just Elon Musk in general here and some of his investments. And that's the subject of the big take story here on Bloomberg News. Elon Inc. is creaking under strain of Musk antics. Max Chafkin, Bloomberg Businessweek senior reporter and co-host of the Elon Inc. podcast, joins us live here in our Bloomberg Interactive Broker studio. So Max, you talk about Elon and some of the off-the-field issues, if you would, in terms of Doge and some of his political movements. Is that impacting his business empire, do you think?
I mean, absolutely. And it's because as much as Tesla is a car company, it is, I think, for many investors, really an Elon Musk company. It's a way to bet on what they see as the singular genius of this guy. And as you said, over the last few years, it's gotten harder to see that. There have been challenges, and I think obviously the biggest challenge is this relationship with Donald Trump, where you had, in December, Elon Musk, helps get Trump elected and then is in this position of extreme influence, probably more influence than almost any, executive ever. And you had this kind of Trump trade where people were bidding up the stock based on the idea that Elon Musk was going to be able to get all of these policies that were going to help his companies. His companies, of course, very, very much enmeshed with the government and heavily regulated. And then we're seeing that in reverse. We're seeing what happens when you have a business and a bunch of businesses, in fact, that are heavily regulated, and you're in a fight with the most powerful person in the world, and Donald Trump. So that's the sort of state of play. And heading into these earnings, Tesla is reporting earnings, I believe, on Wednesday. The challenges that a lot of people have bet on this company have already sort of the futuristic stuff is kind of already priced in. And so he's almost at a point now where he's got to start delivering. And we haven't seen that yet, but maybe we will, in the months that come.
You say in the article that really stood out to me, you say he is rich on paper, but he is cash poor. So kind of explain that to us dig into that.
Yeah, I mean, part of this has to do with the fact that he's always making these big bets. But when you look at his wealth, it is mostly in Tesla stock and options. And he's running this empire, which, obviously includes Tesla. It also includes SpaceX. He's got a lot of SpaceX stock as well. Neither of those companies, he's able to borrow money against his positions in these companies. And we have seen sort of company A buy equity in company B, that sort of thing. But there isn't just like a huge pile of cash. And he has all these things he's trying to do. There's really only one company in the portfolio that is reliably profitable, and that's Tesla. And then you have SpaceX, which of course has a lot of promise and has a dominant position in the launch market, but is not necessarily throwing off cash. And so you have this empire that is very large, but where different companies are supplying things to other Elon Musk companies. And I'd say the most obvious example of that is this XAI investment round, which is already, Elon Musk has already said SpaceX is putting $2 billion in. He's also indicated he's going to try to get Tesla to put $5 billion into XAI. And this is a company that is burning, $1 billion a month. Now, this is the kind of thing that for any other executive, it's like a conflict of interest on top of a conflict of interest. On the other hand, Elon Musk has this fan base that has so far been willing to kind of go along with things that no other investors in any other company would ever go along with.
Is there any reason to believe that the feud, to whatever degree it is at the moment, between President Trump and Elon will de-escalate?
Yeah, I mean, I definitely think that's possible, partly because both Trump and Musk, obviously they're both famously kind of alpha, very tough, but they also both, they forgive. Like people have made this observation about Donald Trump that, although there are a handful of people that are sort of permanently outside of the circle of trust with Trump, people fall in and out of love with Donald Trump, and he is able to kind of look past feuds. Elon Musk is the same way, and there is a mutual interest here. As I said, Trump kind of needs Musk because Musk was the most important financial backer for Republicans during the 2024 cycle. He could very well be the most important backer in the 2026 cycle, and I'd say that Musk kind of needs Trump, both from a branding perspective, from the fact that, like, once you've alienated the entire universe of Democratic voters, which Musk kind of has done, then what do you have left? You have basically the Republicans, and you don't really want to be on the outs with Donald Trump as a cultural force. And then on top of that, you have the sort of regulatory issues. Self-driving, which is what Tesla is betting its future on, is a regulated industry. Rockets, government contractors. So there are all these ways that Donald Trump could either hurt or help Elon Musk, depending on what the relationship looks like.
In the last minute or so we have left, it seems like someone else is kind of sliding into that position. OpenAI, Sam Altman, is he kind of taking over where Musk left the spot?
I mean, incredible, right? Like watching that happen, especially given the fact that Sam Altman, former Democrat, of course, Elon Musk at times has supported Democrats as well, but Sam Altman much more recently was a Trump critic and so on. And that is, there have been a bunch of political sort of missteps made by Elon Musk, and that is, you'd have to include that in the list, just because Sam Altman certainly didn't have the pole position, and now OpenAI, this AI large language model company competing with XAI, is in a position of proximity to the president, and so yeah, that's yet another case where this feud is not helping Elon Musk.
Yeah, absolutely. All right, Max, great work. Really love this story, folks. Check it out on the Bloomberg. It's a big take story. You can see it on the Bloomberg terminal and at Bloomberg.com/big take. Max Chafkin, Bloomberg Business Week senior reporter and co-host of the Elon Inc. podcast, joining us here in our studio. All right, folks, Bloomberg, what do we got here? We got coming up, we're going to be talking to Michael Halen, Bloomberg Intelligence senior restaurant and food service analyst. Got Domino's earnings, pretty solid. We'll just get a sense of what's going on in the restaurant business in general, because that, I feel like, gives you a good read on the consumer as well.
So we got to do a little DoorDash of Domino's. Get that taste of buzz up going.
Exactly right. So we'll keep an eye. We'll talk about the restaurant business here. We got pretty solid performance in terms of the markets here. as we approach midday, up about 0.5 to 0.6% across the board on the various stock indexes. I'm looking at the Bloomberg Dollar Index, weaker today. So we had that little stabilization of the dollar over the last week or so, giving a little bit back here today. Yields also come in. 10-year Treasuries in about 6.5 basis points, 4.35% on your 10-year. So yields drifting lower. Bitcoin, 118,500 for your crypto. A lot more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I consider myself a pizza aficionado. So by definition, I'm not really a Domino's person because I live in a world where there's great local pizza. But for a lot of the world, that's not the case. And so they depend on the Domino's of the world. And they came out and you saw that in the numbers today, some pretty good numbers. Let's break it down with Michael Halen, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence. So some pretty good news out of Domino's. Mike, what'd you take away?
Yeah, listen, they have some nice tailwinds this year. Stuffed crust pizza has done really well. It's really driven some strong same-store sales here in the first half. You know, the industry's about flat in the U.S. and you know they drove a almost 3.5% comp here in the second quarter, so outperforming the market by a pretty significant margin. They also rolled out DoorDash to all their stores in the second quarter, and so they're going to start ramping up the marketing there, and that should give a nice boost to the shares over the next 12 months or so, and maybe beyond. And so, yeah, for those two reasons, you know, we expect them to continue to outpace their QSR pizza and QSR burger competitors throughout the year end.
What about their loyalty programs? I know a lot of analysts were saying, you know what, this is going to be a big boost for them. Did it help out?
Yeah, that was the other thing they cited, and so you know, they rely heavily on households making, you know, $50,000-$60,000 a year and below. And so, you know, as everyone knows, that's been a very weak segment of the restaurant industry for the last few years due to all the inflation, right? And so to bring people back in, they started lowering the redemption, the number of points needed to make redemptions on the loyalty program. And it's been successfully bringing in more carry-out consumers, which are typically lower income, right? And so by bringing those consumers in, you know, it's definitely given a boost to their traffic over the last 3 quarters or so.
So what's Domino's and some of the other restaurant chains that you cover, Mike, what are they saying about tariffs and how that might impact their costs, and how much of their costs will they take in margin versus passing along to consumers? Is there a consensus building?
It depends on the chain, but you know, luckily restaurants source a large majority of their product in the country in which they're operating, right? So Domino's operates in over 80 markets, and all of their product, you know, all of their countries largely source everything domestically, right? And so restaurants are in a good space. You know, the restaurants companies, the stocks got hammered back in April. You know, I think that was largely a case of the baby being thrown out with the bathwater, because restaurants have very low exposure to tariffs, and I think we've seen that in the rebound since April. You know, some of the restaurant names we cover, you know, 2 ones that we like, Shake Shack and Cracker Barrel, they've rallied 100% over the last couple months, and I think they're in a good place because, you know, if people do recognize some price increases at retail, at the mall, stuff like that, whatever it is, 15-20%, they're not going to see those same increases in restaurants and may, you know, look at it as a better value.
So people are still dining out as much as they used to? Because I know I consider myself thrifty, so I cook the entire week, and then we pick one night where we go out to eat. It's a Friday, you know, because Mama don't cook on Fridays. So are more people? Do you see that kind of a change in the habits of the people who are going to eat out?
Well, we've seen that. No, there's no doubt, especially due to all the inflation. We've seen traffic decline now for several years in a row. But restaurants have been able to, you know, the ones that are doing well have been able to more than offset that with price increases, right? And obviously the best performers of the bunch are absolutely able to drive traffic. And that's really about providing a very good experience. Right now, people are very discerning about where they're going to spend their restaurant dollars. When they go out, they want to make sure they're not going to have a bad experience. And so they're continuing to go to places, you know, think Texas Roadhouse, is one that really stands out. They're going to a place where they know they can get good value on the plate for what they pay, a very consistent experience, right? And because of that, you're seeing a wider divergence between the winners and losers in the restaurant space.
Mike, how about labor? President Trump has effectively shut the southern border. Have your companies, who rely to some degree on that labor force, are they seeing it yet?
Yeah, you know, everybody's logged on to E-Verify, and most of our chains, you know, are making sure that their employees have papers and are operating legally. It's more of an impact to, I would say, the independent restaurants in the country. But then, you know, what happens is that ends up being a price competition, and so it drives up prices for labor. And we're seeing another year of about 4 to 5% wage rate inflation in the restaurant industry this year.
And are we changing how people are changing how they eat, right? So in the last 30 seconds or so, GLP-1s, are restaurants cutting back on those portions, making things smaller, you know, less on your plate?
Well, they are, but mainly because of inflation.
Oh, there you go.
You know, GLP-1s, you know, over time, you know, we expect that to be the biggest way to combat that is to decrease the portion sizes and to make sure you have some healthy options on the menu.
Michael Halen, thanks. We always appreciate chatting with you, getting the lay of the land in the restaurant business. Again, Domino's put out some good numbers here today, so good for them. Michael Halen, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence. He's based down there in our Princeton office. For our listeners in the U.S., a reminder, You can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Stay with us. Your top stories and global business headlines are coming up right now. S&P 500 up 0.6%. Same for the Dow. NASDAQ up 0.7%. More coming up. This is Bloomberg. Good morning.
This is CBS News on the Hour, sponsored by ZipRecruiter.
I'm Steve Kathan. A father reports his 9-year-old daughter missing, perhaps abducted. Police issue an Amber Alert, and now he is under arrest.
The suspect has been charged with murder in the second degree and concealment of a human corpse.
New York State Police Major Christopher Gilroy says law enforcement found the girl's body 40 miles from Lake George. CBS's Tom Hansen.
Officers ended up coming across Melina's body at a spot where her and her father were believed to have visited. They found her in shallow water, and then they took the father into custody.
Federal courts hearing arguments in Harvard University's challenge to the Trump administration's blocking of $2 billion in grants and contracts. CBS's Katrina Kaufman.
What Harvard is saying is that it's in violation of the university's First Amendment rights for the government to be making these demands on them. Now, the Trump administration has a very different perspective here. They say this case does not even belong in this Boston federal court. They say it's a contract dispute.
Well, Texas Republicans are poised to redraw the state's congressional map.
It's a move President Trump is pushing as a way to help the GOP retain control of the House in next year's midterm elections. By redrawing the state's congressional maps, Republicans are looking to devise 5 new winnable seats. While the move complicates Democrats' plans to begin regaining power in Washington, it also has risks for Republicans. Some Texas districts considered safe for conservatives will have to add more Democratic voters. Stacey Lynn, CBS News, the White House.
Homeland Security Secretary Kristi Noem says 2 people are held in connection with the wounding of an off-duty border officer in a New York City park. At least one is an undocumented man.
How many more lives will it take? How many more people have to be hurt and victimized before we have public safety be a #1 priority in some of our largest cities?
The officer was not in uniform, and city police call it a botched robbery attempt. CBS's Jim Krasula tells us a second automaker is spelling out the financial hit it anticipates because of tariffs.
Stellantis, the maker of Jeep and Ram vehicles, says preliminary financial figures indicate the company will see a nearly $3 billion net loss in the first half of this year, partly due to U.S. tariffs. A week ago, vehicle maker Volvo said it was taking a $1.2 billion hit because of Trump administration tariffs and production delays.
A judge in the UK has tossed out a challenge to Wimbledon's expansion plans that will almost triple the size of the tennis tournament grounds. Checking Wall Street, right now the Dow is up 245 points. This is CBS News. There's a new look at top states for retirees.
Bankrate found among the top states were New Hampshire, Maine, and Vermont.
One of the things that New England states have going for them is great health care. New Hampshire is ranked the safest.
Wyoming and Idaho also ranked in the top 5. And analyst Stephen Cates says warmth and sunshine are no longer the only factors on where people decide to retire.
COVID kind of shook the snow globe, and we noticed that migration patterns were changing from the traditional snowbird situation.
Stacey Lynn, CBS News.
Well, Superman flew high above the others for a second straight weekend at the box office.
You'd let me interview you as Superman.
Let's do it, Cronkite. Well, taking in more than $57 million. It was down 54% from opening weekend. Jurassic World Rebirth was number 2. I Know What You Did Last Summer debuted at number 3. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
President Trump hits the 6-month mark with an eruption on social media. Welcome to the Monday edition as the president tries to steer around the whole Jeffrey Epstein story with more than 24 posts online yesterday, training fire on the Fed chair while he's at it, and leaving us all guessing about trade deals 2 weeks before the deadline. This hour, we're going to talk this out with Bloomberg's Nancy Cook and David Gura, the host of the Big Take podcast, with analysis from our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us for the duration. And we start, as always, of course, with a look at Wall Street. Haven't seen Charlie Pellet in a minute. He joins us live from World Headquarters in New York. Charlie, how's the market look?
Right now, we are higher across the board. Haven't seen you in a week. Welcome back. We have got the Dow, the S&P, NASDAQ, Joe Matthew rally here, all moving higher. S&P at a record up 34, another 34, 63.31. That is a gain of about 0.5%. Stocks climbing to fresh records. Traders looking for signs of resilience in earnings and tariff risks. Investors, of course, keeping an eye on tariff headlines. Right now, we have got the Dow up 247, up 0.6%. S&P very close to session highs. NASDAQ up 131 for the NASDAQ Composite Index, up another 0.6%. Year 10-year, 4.35% with the 2-year, 3.84%, and the 30-year now at 4.91%. Gold up $48 the ounce, up 1.4%, 33.98 now on the precious metal. A retreat for crude down 0.4%, 67.05 a barrel. Treasury Secretary Scott Bessent says the next round of U.S.-China trade talks could include China's purchases of Russian and Iranian oil. He discussed it this morning on CNBC.
Trade is in a good place, and I think now we can start talking about other things. You know, the Chinese, unfortunately, are very large purchasers of sanctioned Iranian oil, sanctioned Russian oil. So we could start discussing that.
Treasury Secretary Scott Bessent interviewed on CNBC. Stellantis, the automaker, shares lower by 2.5% after reporting a loss in the first half as restructuring expenses, slowing sales, and U.S. tariffs hit the struggling automaker. Stellantis down now by 2.5%. Up 2.5%, I should say. We do have Ford shares up by 2%. And General Motors, which reports this week, GM reports tomorrow, its shares trading higher by 1.6%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back, we go to Washington. Again, big warm welcome back. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much. The voice of Wall Street and the New York subway, Charlie Pellet, he's already coined it the Joe Matthew rally. That can't be good. But I missed you, Charlie. It's great to be back here on the Monday edition on the early side here of Balance of Power on Bloomberg Radio, satellite radio, channel 121. We're live on Bloomberg Originals now, you know, as well as YouTube. Of course, you can always find us by searching Bloomberg Business News Live. That goes for all of our shows from New York and Washington throughout the day. It is one of the coolest things that we have going here on YouTube with Google earnings in mind later this week. So here's the state of play on a cloudy Monday in Washington. It's kind of quiet around here, to be honest, even though lawmakers are still in town. This is it. House and Senate are in session, and soon they'll all be gone. This is it for the House this week. The Senate's supposed to work through the end of the month, even though they're being threatened that they might stay here in overtime to deal with some nominees And the president heads to Scotland on Friday. By the time that happens, dog days of summer kick in here in Washington, right? It's just us and the tourists. And I bet they'll still be talking about Jeffrey Epstein. I haven't talked about this at all on the air. I just didn't know if it was really a Bloomberg story, and we were kind of asking people should take this seriously, whether it was tabloid. The president certainly has been taking it seriously, and boy, what a situation over the weekend. Happy 6 months, by the way. Do you have a Truth Social account? I just asked Nancy Cook this, or do you look at the posts on the terminal? Because it is one of many hundreds of inputs on the Bloomberg terminal. And he was busy. More than 24 posts last night. You go back earlier in the weekend. Wow, the president writes, time flies. Today is that 6-month anniversary of my second term. Importantly, it's being hailed as one of the most consequential periods of any president. In other words, he writes, we got a lot of good and great things done, including ending numerous wars of countries not related to us other than through trade and or in certain cases, friendship. 6 months, Donald Trump says, is not a long time to have totally revived a major country. The posts veered into some dark and odd places over the course of the weekend, culminating with the 24 that went up on Sunday night, including a video of Barack Obama being arrested in the Oval Office. The conventional wisdom here in Washington today is that the president's trying to change the subject, but of course, we turn to Nancy Cook at times like this, Bloomberg political correspondent, senior national political correspondent who covered the first Trump term, the campaign, and now here in 2.0. It's great to see you, Nancy. Welcome back. We're overdue. If you posted all of that stuff over the weekend, wouldn't people be saying, is Nancy all right? And so is the president all right? What is generating all of this, if not an effort to change the subject?
Well, I think that, right, it's just really an effort to change the subject. And the White House has been looking to change the subject on the Jeffrey Epstein story really for the last week and a half.
Yeah.
And you have to remember that this is a sort of slate of conspiracy theories that President Trump used during the campaign. People are covering up things with Jeffrey Epstein. So he is someone who perpetuated this. Mm-hmm. So did his FBI director, Kash Patel. Yeah. So this is one of the many conspiracy theories that animates the MAGA base that helped him rise to power. But now he, now there's a question about his own relationship with Jeffrey Epstein. Is his name in the files? Right. Now he's really trying to redirect the attention. And there's been a fracturing with the MAGA base on it. Sure. Who wants to see, they want to see more. But we've seen Trump really since Friday go hard and try to change the narrative. Mm-hmm. We saw the Office of National Intelligence, release some documents related to Russiagate on Friday, which I was told, by sources was an effort to change the narrative. Mm-hmm. We saw Trump, posting a bunch of things to Truth Social. He's really just doing what he usually does, which is throwing a bunch of things at the wall and seeing what will stick to actually change the subject.
So you see the pictures they're showing on YouTube while we're talking of them together in the good old days, the party pics and all that kind of stuff. It's clearly not working. But it is a president and an individual who has changed the subject just by way of blunt force. If he continues this, do we find a new shiny object? Maybe we get to August 1st, start talking about trade deals again.
Well, I think that, they're trying to talk about the economy, or I think that another way he tried to change the subject last week was by, some of his aides floating he was going to fire Jerome Powell on Wednesday. Yeah. And then at the White House, he said, oh, of course not. I'm not going to do that. I mean, really, they're looking for any chance they get. I'll be curious to see how long this particular storyline has legs. I mean, it doesn't seem to be ending. There's just, there was the Wall Street Journal story about that letter that Trump sent Jeffrey Epstein. The New York Times has done a series of stories. I think that there's just going to be a drumbeat of stories about what's actually in the files and what that relationship looks like.
Now that we're seeing the big front pagers, like you said, he's suing the Wall Street Journal, or at least said he would. I don't know that that's been filed. He was going to sue Rupert Murdoch. News Corp owns the Wall Street Journal. Then the New York Times shows up with a big dive on their relationship, how friendly they were, and for how long. You've been in this business for a minute. When you see a scandal, if I can use that word, when you see a story like this reaching these proportions, what does that tell you is coming next? Does it just keep burning?
I think it's just going to keep burning. And it's funny, again, like, it's ironic because he did use these conspiracy theories to rise to power.
Yeah.
But now it's funny that his White House is saying, oh, we just want to talk about our policy wins. You know, we just want to talk about immigration or the tax bill. Like, they're trying to pivot back. One of the additional ways they're trying to pivot back is to talk about the policy stuff.
My poll numbers, he writes, within the Republican Party and MAGA have gone up significantly since the Jeffrey Epstein hoax was exposed by the radical left Democrats and just plain troublemakers. He writes in a separate post, they have hit 90, 92%, 93%, and 95% in various polls. Have you seen any poll showing an approval rating in the 90s like that?
No, I mean, I do think that he does have a higher approval rating if you ask Republican voters than just sort of general voters. It is higher. I think it's more like in the 70s or 80s. But again, that depends on the issue. But, you know, his approval rating is, you know, more of what a typical president would be at this point.
He's threatening to block the stadium deal for the Washington Commanders, which was known for some time as Washington's football team. Remember when that's what we called it in public? The Washington whatevers, he writes, should immediately change their name back to its original name. He says there's a big clamoring for this. He went on to write further in a separate post, my statement on the Washington football team has totally blown up, but only in a very positive way. When you see posts like this, does this bring us back to the old whoever spoke to him last line? Was he on the phone with a friend that got him going on the football team? How did this become the story?
It could be. You know, you have to, one thing about covering Trump for a long time is he there's so much input from him. And so he watches TV constantly, regardless of what his aides will say, oh, he doesn't. He always has the TV on. You know, he is always sort of on social media checking it out. He also is an avid reader of newspapers. You know, he really pays attention to what's in the New York Times, what's in the New York Post, what's in the Wall Street Journal. So he just takes a lot of information. And also he loves to get on the phone. You know, he loves to hit up friends. You know, I think this term he's talking to a lot more sort of tech and Silicon Valley people than New York business people, but he just, you know, old friends. So you never know exactly where this information is coming from, but that could have come, he might have seen an article in the Washington Post and had a reaction to it and put it on.
The fact they haven't landed this this stadium yet. Well, you know, he's talking to Howard Lutnick a lot. This story in the New Yorker is something from Money Talks, a 10-page profile. They're talking on the phone, Nancy, every night by the way, Howard Lutnick gets into bed. They get on the phone together. He said they talk about real stuff like tariffs. They talk about nothing, which he described as, quote, sporting events. People you'd like to have dinner with. What was this guy like? Can you believe what this guy did? And to your point, what's the TV like? I saw this on TV. What did you think of what that guy said on TV? It really kind of brings you this down to the same guy who was meeting Elon Musk for ice cream in the White House late at night. What is that side of Trump?
Well, Trump has like never been a great sleeper, and so you know,
one answer.
I know, and so for some reporting I did for a big piece we did on his first 100 days, you know, I was told, for instance, in the middle of the night when he can't sleep, he has started listening to podcasts.
How about that?
I know, and so he's been listening to podcasts.
Does he put the earbuds in?
I mean, I'm not there with him,
fantastic.
but I was just told, you know, he's become an avid podcast listener.
That is fantastic.
And has been listening to historical podcasts.
Okay.
And so that's like another thing that's added to his social media diet. But he's always been someone who doesn't need a ton of sleep. You know, he's always been someone, you remember from the first term, who was like up tweeting at 6 a.m.
Yeah.
This is his vibe.
But also someone who likes the kibitz.
He
right?
does.
He likes
loves
the phone call. Hey, are you in bed? I'm in bed too. What'd you see on TV today? It's absolutely a great read. Apparently, big fan of the Big Take podcast. We're going to talk to David Gura about that coming up. The great Nancy Cook. Great to see you, Nancy. Come by more often.
Thanks
Bloomberg National Senior Correspondent. I'm Joe Matthew on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Developing story. We begin with a headline right off the Bloomberg from Fox News. Fed Chair Jay Powell hit with a criminal referral by a House GOP Trump ally. Again, that from Fox News, the headline developing a story and the headline right now on the Bloomberg. Stocks do remain higher. We're looking at records. We're also looking at the S&P at very close to session highs right now, up 31, 63.28, gain there of 0.5%. The Dow up 244, also a gain of 0.5%. NASDAQ up 106, trading at a record as well, up 0.5%. 10-year 4.35%, the 2-year 3.83%, 30-year 4.92%. Gold now up $48 the ounce, up 1.5%. West Texas Intermediate crude down 0.4%, 67.10 a barrel on WTI. Earnings news. Domino's Pizza, DPZ on the ticker after earnings. Domino's down 2.5%. Rival Papa John's Pizza up by 0.8%. And Yum Brands, the parent of Pizza Hut, we got Yum down now by 2%. Again, recapping, stocks higher, S&P up 31, up 0.5%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, many thanks, sir. Live from World Headquarters in New York, Charlie Pellet, as always, steers us to the breaking news. And so when Donald Trump gets on the horn tonight with Howard Lutnick, and they're talking about the stuff they saw today, surely Anna Paulina Luna is going to come up. Having just referred Chair Jay Powell to the Department of Justice for criminal charges, this march to get the man fired is getting louder, accusing him of lying to Congress, specifically twice, about the whole renovation that's taking place at the Federal Reserve building. Quote, on June 25, 2025, she writes, Chair Powell provided testimony under oath before the U.S. Senate Committee on Banking, Housing, and Urban Affairs regarding the renovation of the Federal Reserve building. In his statements, he made several materially false claims, accusing him of lying, according to Fox News, about lavish amenities at the Federal Reserve's building, misrepresenting its state of maintenance. Remember, he said, no VIP elevators. Hey, there it is. If you're with us on YouTube, it looks like a big construction site right now, and you go by there on Constitution Avenue. They are going to have, I guess, some vegetation up on the roof. You ever been on one of these buildings? You know, it helps to absorb the sun or something. It's not supposed to be a big garden party. At least this is what the chair's saying. Gets to be a little bit different when it comes to Anna Paulina Luna. I was talking to producer James, though. He's back today as well. America's producer, don't you worry, is back at the helm. Talking about when it comes to renovation and specifically renovating government offices, what's happening at the White House, if we're leading by example, is striking. There's clearly not enough gold leaf at the Federal Reserve building. After the president talks to Howard Lutnick later, he's going to put his earbuds in and listen to this man. David Gura, the host of the Big Take podcast, is actually with us now, right now, yes, on Balance of Power. You're right, David. The Rose Garden is a construction site as well. They're redoing all this stuff.
Making it a patio.
But maybe, you know, if Jay Powell upped the gold quotient a little bit here, he'd be on brand.
We do know that President Trump in his first term, I think, had a whole schema about what he thought federal architecture should be in the U.S. So he is a man who, of course, made his career in real estate, knows it well, and has opinions, shall we say, about how buildings should look and how they should be constructed. So this is squarely in the sweet spot, I think.
Well, it's great to have you with us here because there's a lot I'd like to talk about. I didn't know we'd have this moment in time. You just got back from Aspen at the Security Forum. But what do you think about the rallying cry here, the drumbeat, whatever cliche I should be using, to fire Jay Powell? Is this trying to change the subject away from a guy named Jeffrey, or is there more to this? Does Donald Trump actually think ripping off the Band-Aid and firing Jay Powell before the end of his term is worth it?
Well, Jeffrey Epstein didn't come up over the course of my time at this conference in Aspen, which bills itself as kind of the premier national security and foreign policy conference in the U.S. And just to set the stage here, this is an event that happens every year and historically has attracted both Republicans and Democrats and members of the administration, whichever party it's in power. That wasn't the case this year. There was supposed to be a series of interviews with Republicans, including John Cornyn, Cornyn, the senator, was supposed to be on stage for a Q&A. And then a whole host of generals were supposed to be there, combatant commanders. And at the very last minute, Pete Hegseth at the Pentagon decided that they wouldn't attend. So that was kind of the backdrop to all of this. And I did get some time with Senators Mark Warner and Chris Coons one-on-one while I was there. And this is something that I brought up to Mark Warner in particular, knowing that he's on the Banking Committee and the Finance Committee. And he sees this as a distraction. He thinks that Jerome Powell's record is one that most Americans would endorse, the work that he did during and after COVID with his colleagues on the FOMC to bring inflation down. He sees this as a distraction, and he acknowledged to me in an interview that he thinks most senators on both sides of the aisle agree with him, that they see what the House is doing here in particular, and this Congresswoman's letter that you just mentioned as part of something that's merely a distraction. Mark Warner said to me, who hasn't embarked on a renovation and had it go over budget? So he sees this as in keeping with that, part and parcel of that, Joe.
Well, I was going to ask you if you've ever renovated a kitchen before, David Gura, but before I get into more of what you discussed with lawmakers at Aspen, what was the purpose for Republicans peeling off? Am I hearing you right that this became a Democratic-leaning affair, and if so, why?
That's certainly how the administration was painting it. And I spoke with Ambassador Nicholas Burns, our former U.S. ambassador to China, who runs this, helps put it together along with Condoleezza Rice, the Secretary of State. And his message to those who are gathered there is the door is always open to members of the Trump administration to participate. That this was a conference born of getting folks from D.C. together outside of D.C. to talk about issues of international importance. And so there were folks from Ukraine who were there, folks from Asia. It has a very global flavor and feel, but by not having participation from the White House and the Pentagon, it did feel as though it was being pushed in a different direction. He really wanted to push back on that and said, look, this is something where you come here and your political affiliation goes to the wayside. It's just a chance to have hard conversations. But this was my first foray there, my first time being there. And other journalists I spoke with who'd covered it, other participants who were policymakers past and present, did say it had a different feel this year because it wasn't full of newsmakers in the way that it was in the past. There was kind of a lack of that frank conversation that you would have if you had, again, serving generals who were present, Republicans as well as Democrats. So it'll be interesting to see sort of how this carries forward. But the way that the administration is painting this is something that is a globalist, to quote Pete Hegseth, focus, and one that's not in line with the administration today. And that was his rationale for not sending those generals to participate.
Wow, isn't that fascinating? To your point, this has been a really important opportunity for a lot of folks to talk about some big ideas here. And I'm picturing you in Aspen now, David, surrounded by Democrats who were pretty sore about what was going on in Washington. The rescissions package passing, even further deepening the lack of trust between these two parties. And I'm guessing you heard a lot about it.
Yeah, so just to paint the picture, there was an event. Peter Baker of the New York Times moderated a conversation with Chris Coons and Mark Warner, the two senators on stage. And as I say, John Cornyn was supposed to participate in that. And both of these senators looked incredibly weary, and they'd been up for many hours as this legislation made its way through Congress. And Senator Warner made a joke that this was the fourth sleepover they've had in the Senate over the course of this year. So they're becoming accustomed to staying up late. But this rescissions issue is something that clearly got in the crawl of Senator Chris Coons, of course, is on the Appropriations Committee. He sees himself as somebody who can approach issues with a lot of equanimity. He made the point to me that if you're going to sit on the Appropriations Committee, you are by nature somebody who wants to work across the aisle and make deals. Let me just play a bit of tape here from the conversation that we had about rescissions, because he sees this as something that's worrisome as the Congress approaches a crossroads here in terms of how they legislate and appropriate. Here's a clip of what Senator Coons said to me.
It shows that President Trump and Republicans in the Senate and House are trying to change the whole balance of power between the Congress and the executive. Our framers imagined that, yes, there would be factions, there would even be parties, but they assumed that leaders in Congress would, in the end, have a greater loyalty to their role and to their institution than to their party. This is a moment where that is not true. We could not find 4 Republican senators to stand up and say, as appropriators, our job in defending what we have agreed to is more important than our job as partisans.
So Senator Coons is very worried this is going to be the playbook that the Trump administration is going to use going forward here, that we're going to see CR after CR after CR with reconciliation packages and rescissions packages, and that appropriators like him are no longer going to have a job. And he's very much of the belief that what's happening here is the Congress's role is being usurped by the administrative branch. And he's clearly frustrated that Republicans are going along with this. They are ceding that ground to the President of the United States. And he sees this as part and parcel of kind of a bigger plan being orchestrated and executed by Russ Vought of the Office of Management and Budget, again, trying to exert greater control over the budgeting and appropriations process in the service of making a lot of cuts despite what Congress wants or has decided, and focusing a lot more on funding for Homeland Security and defense and things like that, Joe.
Well, you have to wonder if he's wrong, David, and if in fact we are in a world where a government shutdown is more likely. Remember, the line from Vought and many lawmakers was, if this rescissions plan passes, we're going to have more bigger versions of this. And so why ever would Democrats get involved in an appropriations process? Who's Chris Coons on the other side of the table from?
Yeah, that's a great question, and I think that we saw an element of this last week during that Senate Judiciary Committee meeting on Emile Beauvais, the nominee to be on the Third Circuit Court of Appeals, where you had Democrats walk out of the room, and I asked Chris Coons about that as well. He sits on that committee, and I mean that's a signal moment too, where Chuck Grassley chairs that committee. I think Chris Coons has a lot of respect for him and the way that he has run that committee, but to not allow, yes, a whistleblower to testify, but not to allow Democrats to opine or comment in any way before that vote clearly was something that upset him and other Democrats on that committee, and I think showcases the enmity that we're seeing among parties in the Senate today, Joe.
So I guess the big question is what's next? And maybe it is another rescissions package. They're going to try to get some spending bills. Tom Cole's still hoping to get this done and find some semblance of regular order. But you could make the argument, David, that the store is closed after the big, beautiful bill.
It does feel that way, and in this conversation, we'll put more of it out on the podcast in the days to come. There's this sense that we're at a crossroads in Congress. I think Senator Coons feels that way, that this is a moment to kind of really save the institution as we and he knows it. And so I think that's where we're at. And I should say, before I embarked on this trip, we had Jody Arrington, the chair of the House Budget Committee here in New York, for a roundtable with me and a few other Bloomberg reporters and editors. And he was pretty unabashed that the plan going forward here is to see another big, beautiful bill, one that might not be as big or as beautiful, but that's the mode and the model that they're looking for here, Joe, going forward. So that's in the backdrop. That's what's happening. And then I think going with that, in complement to that, is just the sense of deteriorating trust between both parties and a feeling that the institution of the Senate and the House, as they've known it, is really changing here and could be changing irrevocably.
Well, the idea of living on CRs and reconciliation could bump into reality when it comes time for the midterms. But of course, we can deal with that then. The Democrats have experienced this as well, David Gura. I was thinking earbuds for Donald Trump because the over-ear headphones would mess up the hair and everything. But he probably puts that on the speaker and listens to it in the room, right?
I'm going to go back to my team right after this and say, now I know the president, a big fan of podcasts, and how do we capitalize?
Start speaking directly. Audience of one, my friend.
Go.
Yes, indeed.
There we go. An intimate medium.
Always a pleasure to have.
Nice to talk to you.
Always
Joe.
A pleasure to have David Gura. Thank you, sir. Live from World Headquarters, the great David Gura, and the podcast is The Big Take. Find it on Apple, Spotify, and all of the same platforms you find Balance of Power. We'll assemble our panel next. Everybody's coming off the weekend with some ideas that we want you to hear about, including Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors. We'll dig into this whole controversy at the White House a bit more with our panel coming up next on Bloomberg.